Welcome, everyone. Thank you for joining us today for Realty411's Virtual Investor Summit. It's a pleasure to have you here with us, and we're so excited to be sharing this day with you. And our first speaker of the day is Steve Davis with Total Wealth Academy. So, hello, Steve. How are you?
Excellent, Linda. Doing good. How about you?
I'm well. Thank you so much for joining us today. It's such a pleasure to see you and to have you with us.
My pleasure. Lots of fun.
Yes, you made such an impact the last time you were here. I know that you had great feedback from our listeners, and
I did.
reached out to you. So we're really excited about you helping our listeners and our readers get to that next level of where they want to go in their real estate business. So today, Steve is going to share some insight to help you with your investing goals. And folks, even with an effective map, investors need to know where they're starting from so they can know where they're going to end up and the destination. Isn't that right, Steve?
Absolutely. It's very important to be objective. Look at where you're at now and recognize where you're deficient, where you need work, where you need education, and so on.
Wonderful. Well, with this in mind, Steve, we're going to go ahead and let you take it away. Would you like to share your screen?
No, I'm going to do this just without the PowerPoint. I have a PowerPoint, but it's new material and I haven't tested the PowerPoint yet. I don't want to have the wrong stuff up there.
Great. Well, we're going acoustic today then.
Yes.
Awesome. Well, Steve, take it away.
All right. Thank you. Hi, everybody. Again, my name is Steve Davis, and I am the founder and CEO of a real estate investor group called Total Wealth Academy. We have members across Canada and obviously across the United States. We are a mentoring program for real estate investors, and we work with people on everything from single family houses to big apartment complexes, senior living complexes, self-storage, and so on. Probably 80% of our members are passive investors and about 20% are active. What I want to start off with is something that I think will help everyone. And it starts off with a question, which is, what is anything with two heads? What's a creature with two heads? It's a monster. Yet most families in the United States are trying to run their families with two heads, both people in charge. Now, I want you to think about this. Would you ever go into combat with two generals in charge? Absolutely not. No one would be able to make a decision, and it would destroy you. You wouldn't survive. Yet I hear this a lot. I got to talk to my spouse before I make a financial decision. This is the most ineffective thing that you can possibly do. I once bought a multi-million-dollar company for $0. Guess what they had? Two CEOs, two heads, and it destroyed the company. And I bought it, as I said, for $0 and was able to capitalize on the stupidity of having two people in charge. And I want to make sure this is clear. These two women were both brilliant, both wonderful people, but you can't have two people in charge. I had another situation where a brilliant couple came to me with a fourplex. The thing made $1,000 a month cash flow. It was a $50,000 equity pickup. It was a no-brainer. They sat in my office and I said, so you guys going to do the deal? They looked at each other. One of them said, what do you think, honey? The other one looked at him and said, no, I don't know. What do you think, honey? They couldn't make a decision. You have to have a leader in your family. for each arena of a balanced life. We'll talk about finance primarily today. One of you has to be in charge. You can get your feelings hurt. You can feel, oh, we're equals. No, you're not. And if you are equals, you will never get anything done. Someone has to take responsibility. Someone has to step up and make the decision. And the interesting thing is, whenever a person hits me with that, they go, well, I'd like to join your group, but I got to go chat with my spouse. I always ask, oh, is your spouse a multimillionaire entrepreneur? No. Then why are you asking them for financial advice? It makes no sense. Two people in the same financial position asking each other for advice, it's ridiculous. It is completely ineffective. So what I'm encouraging those of you who are in long-term relationships, whether you're married or not, put somebody in charge, make somebody responsible, and one of you step up. Stop hiding behind your spouse. It's a cop-out. Oh, I have to talk to my spouse. It's a cop-out. That's what it is. One of you needs to be the leader for the finances. Your spouse can be the leader in other arenas in the family, but somebody's got to be able to make a decision, or you'll never get a single real estate deal done, period. So there's my little pitch on that. Let's move into what I really want to talk about, which is I'm a big passive investor, and I believe in passive investing. And I also believe that it is not an option anymore. At one time, building a second stream of income was an option. You could save your way to retirement. You can't anymore. It literally, to have $10,000 a month in retirement income, you have to save up $3 million. And I want everybody to think, are you on the path to saving $3 million before you retire? People need to be aware that the average couple spends $750,000 on medical expenses in old age. So $3 million is not a huge amount of money to retire with, but it is very difficult for people to save it. Whereas building a $120,000 a year passive income stream, you could probably get that done with as little as $600,000. So which do you think is easier to save, 600,000 or 3 million? I'll suggest the $600,000. So before we head into this, we have to make a distinction. And that distinction is that there's a difference between speculating and investing. Speculating and investing. They are two different things. And so the first thing that you want to understand is that speculation is stocks, mutual funds, gold, silver, crypto. Those are all speculative in nature. And what speculation means is you're buying low to sell high. The poor and the middle class think that's how you make money. You buy low to sell high. An investment, unlike speculation, makes money generally two ways, and with real estate, 4 ways. But we'll just deal with 2 of those today. That is appreciation and cash flow. See, for one of these things to be an investment, it has to produce cash flow. If it doesn't produce cash flow, then that is speculation or gambling. You're buying low to sell high, such as, again, stocks, gold, silver, crypto. With real estate, you get the appreciation by default. You buy for cash flow, and the appreciation is the icing on the cake. When you're a speculator, a gambler, the icing is the cake is the appreciation. Sorry, the cake is the appreciation. It's also the icing, because it's the only way you make money is if it goes up in value. But what do we know about stocks, gold, silver, and crypto? It's not if they're going to crash, it's when. Same thing with real estate. The good news is it's not if they're going to recover, it's when. So the average rate of return, I guess I better address this. The average rate of return of the stock market is 7.5%. That's all you're going to get. If you think you're going to get more than that, you have unrealistic expectations. For the last 75 years, the stock market has averaged 7.5%, even with the ups and downs. So there's your rate of return. It's guaranteed at 7.5% that you'll never get rich and you'll never retire. You have to have a higher rate of return than that. So when you're gambling in the stock market, you compare that to investing in real estate. My average rate of return is about 3 times that of the stock market over the last 30 years, right around 20, 21, 22%. So I'm making 3 times what the gamblers are. And that's not including the appreciation. That is the cash on cash rate of return that I've averaged with my single family homes. My apartments, it's a little bit different because that's gauged in an internal rate of return, but you get the point. I'm making 3 times what people in the stock market are making because I educated myself and I have a different set of skills. So when you understand that when you're a speculator and a crash comes, and again, it's not if it comes, it's when, you lose money. An example would be, let's say it's 2006 and you turn 65 and want to retire. 2007, the Great Recession rolls around. Your stock portfolio, which was worth 1 million, is now worth 700 grand. You're screwed because you were gambling. And what people need to understand, males, not so much, but females, you're going to live 18.5 years in retirement. Do you realize you're going to see 3 stock market crashes in that 18 years? 3. Why do I say that? Because the stock market has crashed 18 times in the last 100 years. It's not if it's going to crash, it's when. And in retirement, if your money is in speculation, like the stock market, gold, silver, crypto, you're going to see those crashes 3 times. That can be devastating when you're not bringing in any additional income. Whereas with real estate, go back to 2006. Let's say you have 40 rent houses. You're making $20,000 a month. In 2007, the real estate market crashes. Your property values drop 50%. They didn't, but let's say they did. Do you care? No. What's your cash flow? It's still $20,000 a month. Do you see the difference between gambling in those speculative things and investing in real estate? When 2007 hit, I was in 4,000 apartment units. All of them dropped in value 34, 40%. Did I care? No, because the cash flow kept coming in and it even went up. Why? Because everybody that was losing their home was moving where? Into rent properties. My single family homes went up $100, $200 a month, and my apartments went up $100, $150 a month per unit. Let's say I was making 80 grand a month before the recession. After the recession, I was making $85,000, $87,000 a month because of those rental increases. So make the distinction that there is a difference between speculating, buy low to sell high, and investing where you're creating cash flow. And my sales pitch is this: sooner or later, you have to have cash flow. If you're ever going to retire, get out of working, you've got to have cash flow, because every month your bills come in. So let's deal with a few of these points right now. The first one is, again, I apologize, I've got a new PowerPoint that I'm going through. I want to get back to why you need passive income. First off, as I mentioned, saving your way to retirement doesn't work. As Robert Kiyosaki says, the reality is today's money has fake value and it's making you poorer. And if you are a saver, you are a loser. This one's simple to analyze. If you've got money in the bank and inflation is 8%, that means that $100,000 you have in the bank is now only worth 92. Savers are losers. 2, and we addressed this, but I'm going to say it again because people don't believe this. To have $10,000 a month in retirement, you must save $3 million. $3 million. It's a thing called the 4% rule. To ensure that you don't run out of money before you die, you're only allowed to take 4% of your savings every year. So that's $120,000 a year on 3 million or $10,000 a month. Now here's the problem. Does the 4% rule work every time? No. What if you live 30 years in retirement? You run out of money. So it's not a good idea, again, to save your way to retirement. The next one is the IRA and 401k are epic fails for America. If you've got money in an IRA or a 401k, stop it. They do not save you taxes except in one instance. And that instance is if you retire with low income. Now, everybody ask yourself this question. Did you wake up this morning, look in the mirror and go, yeah, I'm gonna have a great day because my goal is to retire with low income. Yeah, that's my goal. None of you. Your goal is not to retire with low income. Then why is your money in an IRA or 401k when the only way they save you taxes is if you retire with low income? Take this example. If you make $100,000 a year, you're in the 22% tax bracket. Let's say that you save up $1 million and you decide to take 100,000 of it a year. When you take $100,000 out of your IRA, guess what tax bracket you're in? 22%, just like when you were working. But you lost control of that money for years. The IRA and the 401k are epic fails for America. They don't save you taxes unless you fail financially. But again, that's not your goal, is it? You don't want to fail financially. You don't want to retire with low income. So it is completely useless to put money in an IRA or 401k. You should keep your money and invest it and build passive income. For those of you with IRAs and 401ks, be aware that you can use that money to invest passively in real estate through a thing called a self-directed 401 or a self-directed IRA. But you got to get control of it and do it yourself. But stop contributing unless you plan on retiring with low income. The next point is why saving your way to retirement doesn't work. There's proof. 95% of Americans fail to retire by age 65. 28% are dead by age 65. So let's deal with the golden lie. It's a thing called the golden years. The golden years are a golden lie. It's a bunch of horse crap. You got to understand, getting old sucks. It sucks. I'm 57. I hate it. I'll give you my Ferrari, my boat, my beach house, I'll give you my home. I'll live on the streets. You can have all my money, everything. Give me my body back from 30. Give me my body back from 30. You can have everything I got because I know I can rebuild it. But getting old sucks. And everybody's telling you, don't live life, scrimp, save, and you can travel when you retire. You can do this, that, and the other when you retire. It's a bunch of bull. I'm telling you, it is better to make love to your wife under the Eiffel Tower in your 30s and 40s than it is in your 70s and 80s. No, you want to live now, and cash flow allows you to do that. So men, this is the second reason you need passive income. The first was because saving your way to retirement doesn't work. The second reason you need passive income, I mentioned this statistic, men, your wife's going to outlive you by 18.5 years. Are you prepared for that financially? For her to be without you and your income for 18.5 years? You better start preparing a second stream of income for her to live off of those 18.5 years. The third reason you want passive income is because your bills get higher as you grow older. Everybody's out there telling you, oh, your kids have moved out, there's no college, there's no this, there's no that. I haven't talked to one elderly person that has told me that their bills dropped. And it's a thing called medical expenses. As I mentioned earlier, the average is $750,000 that an elderly couple is going to spend just to stay alive in retirement. So the other thing is, you don't want to get rich when you're old. You want to get rich now. Now. Do it now. Okay. Now, those are the four. Oh, I missed one. Number 4. You miss out on life if you don't have a second stream of income. An example of this is you want to take your wife to Europe for a month, but you have a job and that's your sole source of income. It's your only source of income. Can you take that month off? Probably not. But if you had built a second stream of income that paid all your bills, could you take a month off? Head to Europe for a month? Absolutely. See, those of you that rely on a job for your income, your quality of lifestyle is extremely low by comparison to someone who has a second stream of income and can do what they want, when they want, where they want, and with whom they want. So those are the 4 main reasons why you want passive income. Let's talk about why you should use real estate to build your second stream of income. Now, some of you have heard this stuff before, but because I've shared it before, but this is so important for you to think about. It's first, by doing so, you can retire at any age. I have personally met and mentored kids in their 20s who generated $10,000 to even $20,000 a month in passive income from their real estate. I want you to think about this for a moment. Go back to age 25. What would your life have been like if you had $10,000 or $20,000 a month in passive income coming in? Would it have been a higher quality than it was? It would have, wouldn't it? See, there's no question that building a second stream of income improves your quality of lifestyle throughout your life, not just in your 20s. The second is that when you study, remember the statistic, 95% of Americans fail to retire by age 65? Well, when you study the other 5%, the 5% who do retire successfully, you're going to find out that 90% of them used real estate as their main vehicle to create a second stream of income. 90%. Now that statistic's not new. Even at the turn of the even in the 1900s, Andrew Carnegie was telling people that 90% of the millionaires out there used real estate as their main vehicle. And that statistic holds true today. All right. Third reason you should choose real estate to build this is because real estate's the lowest risk investment out there. It's the lowest risk. I don't care what anybody says. I have debated this with, well, never a stock guy. No stock guys are willing to even challenge that. But there were people who were talking about owning a business and things like that. I've had to debate, and it's never even been close. The lowest risk investment out there is real estate because we make money in both the up and down markets. In fact, with this impending recession, do you know what we're praying for? A big crash. We want the real estate market to crash. Why? Real estate, in many cases, now don't get me wrong, we make money in the up market. I get it, it's the up market. But what people don't realize is that we make more money in the down market. It was unbelievable. In 08, 09, 010, there were 0 down single families on every street corner. I think my average out of pocket, I picked up 20 of them because I couldn't resist. I wasn't even buying single family. I just couldn't resist it. I think my average out of pocket on those deals was around 20, but a lot of them were $5,000, $6,000 down. That was it. You can buy a lot of real estate in a down market. We picked up apartment complexes literally at half price, 500 units for the price of 250 units. It was insane how much money we made during the recession. And you should too. You just got to know how to do it. The next point, the conclusion to this portion is simple. To have the highest quality of lifestyle, to live well while you're young, to be able to retire at any age, you must have passive income. And the sad thing is, eventually, every one of you is going to get fired. Around age 60, 65, you're not going to make it to 70. At a job, they're going to get rid of you. Just face it, be prepared for it. Or at 65, 70, you don't want to work anymore. It makes sense that you need passive income, because when they fire you, you better have some income. Or if you decide you want to retire, you better have some income. So with all of that said, you're in the right place here at Realty411. They are sharing with you ideas, strategies. It keeps you motivated. It's encouraging. Realty411 is just a great tool, great product to keep yourself up to date on laws, information, things like that, but also to keep yourself motivated by attending workshops like this. So the last thing I'd like to cover is the 4 ways that real estate makes you money that a lot of people are not clear about. Many of you know this, but real estate, every dollar you have in a piece of real estate makes you money 4 ways: cash flow, equity capture, appreciation, and equity buildup or principal pay down. This is why many of our single family homes that my students are buying, they're actually making an internal rate of return in excess of 60%. 60%. Remember, compare that to the stock market, which is 7.5%. And if you expect to get more than 7.5% out of the stock market, you simply have unrealistic expectations. That's the last 75 years. So let's talk about cash flow, because to me, it's the most important. It was what allowed me to quit my job. It was what allowed me to spend massive amounts of time with my spouse, massive amounts of time with my kids. It allowed me to hit the gym. It allowed me to give to the charities of my choice, and so on. But I'll give you an example of a house that's now worth probably 350, but I picked it up when it was worth about 200. I picked it up for 115. It needed $45,000 worth of work, and my hard money loan cost me about 10 grand in holding costs and closing costs. So my all in on that deal was 170, and it was worth 200. That thing made me about $350 a month after principal, interest, taxes, insurance, maintenance, and vacancy included. $350 a month is $4,200 per year. My total out of pocket on that deal was $20,000. So if you take the $4,200 and divide it by the $20,000 I have in it, that's about a 21% rate of return. And that's what I've told you. I have made that consistently for 30 years in cash flow, which is 3 times what the stock market and those other speculative things make. And that's the cash flow. The next is the equity pickup. The equity pickup is the difference between my all-in price and the ARV. The ARV was 200. The all-in price was 170. The difference is $30,000. The day I closed that deal, my net worth went up $30,000. So $30,000 divided by the $20,000 I had in the deal, that's 150% rate of return. 150% rate of return. Compare that to what you're getting in the stock market. The next is appreciation. And this one's really misunderstood. Appreciation on real estate is only about 3% a year, or it doubles in value every 20 years and has since 1776. But it's only 3% a year. What would your financial planner say? Well, your financial planner who owns no real estate and isn't qualified to talk about real estate is going to say something like this: I can get you 7.5% in the stock market and you don't have to deal with tenants. Don't do real estate. Well, let's look at the actual rate of return. Even though appreciation is only 3%, 3% of $200,000 is what? $6,000. To get your rate of return, you divide that by the amount you have in the deal. 6,000 divided by 20,000. It's not a 3% rate of return. It's 30% rate of return. 10 times what your financial planner told you. And let me hack away at financial planners for a second. This is no disrespect to them as human beings. It's just the simple facts. Do you know the average financial planner in the United States makes $100,000 a year? And what you do is you get desperate. You're not in the financial position you want to be in, so you go hire a financial planner. And here's what you say to them. You didn't say this out loud, but think about it. You walked up to your financial planner and you said, hey, I know you don't make a lot of money. I know you're not rich. I know you're not retired, but can you teach me how to get rich and retire? They can't help you. They've never done it. They don't know how to do it. So be cautious who you get your advice from. Sorry to give the sales pitch. You need your advice from a multimillionaire entrepreneur like the mentors here, not from a financial planner who makes $100,000 a year. Okay, the next way that real estate makes you money is, wait a minute, what did I hit? I'm sorry, equity buildup. Sorry about that. Equity buildup or principal pay down. All that refers to is every month that your renter pays their rent, you make your mortgage payment. When you do, you're reducing what you owe on the property. That's profit. Now, it's not going to be a lot. It's going to be about a 10% rate of return. But even that, just principal pay down beats the stock market. When you add those four together, the first year that you own a rental property, it's a 210% rate of return. 210% rate of return. The second year forward, because there is no equity capture the second year, equity capture was the difference between what you paid for it and what it's worth. You don't get that the second year. It's going to drop down to about a 60% internal rate of return. How many of you would like to start getting a 60% rate of return? If so, you're in the right place with Realty411 because you're getting the information. You just got to get out there and take action. I do strongly believe in coaches. I built this company because coaches helped me so much and changed my life. So get out there and do this stuff. Every one of you has the potential to do it. I'll give you a story of a guy who couldn't read, not very good grammar. He literally paid his membership fee in rolls of quarters. I asked him if he had any more money. He said, well, I got bus fare home. That guy went on to buy something like 23 houses, several small apartment complexes, 20 to 40 units. If he can do this, you can do it. Another lady, Alyssa, made a decision when she couldn't fill up her car tank because she only had $4 in the bank and she had two twins sitting in the back and she was a single mom. She now owns 2 apartment complexes and a self-storage complex. Again, single mom with twins and $4 in the bank. I don't care what excuse you have. It's not that bad. It's not that bad. You can do it. So, okay, I can talk more, but I'd really like to get some questions before we do. Can we open up question and answer on the 4 ways that real estate makes you money?
Absolutely. The chat is open. You do have one comment already from a Miss Miller who says that yes, it is awesome. So I think she meant the passive cash flow is awesome. So
Yeah,
folks, we did have an issue yesterday with the chat. Unfortunately, the settings got messed up and the chat was not working yesterday. However, the chat is working today. In
excellent.
addition, we have the Q&A also available. This is your opportunity to ask Steve questions. This is your chance to gain some insight on something that may be perplexing you about your deal or a deal that you're looking at. So please take advantage of this opportunity that we have with Steve and all the knowledge that he has and ask him any questions that you have. Now, Steve, you are located in the Houston area, is that right?
Yes, but we have students all across Canada and the United States.
Wonderful, wonderful. So in particular, if anyone is interested in gaining some insight on the Houston area market, because I do know that we have a lot of investors in our network that are possibly purchasing properties in Houston or they're looking at deals in Houston. Houston is a big market for people in our network. So keep that in mind when you're asking questions to Steve, if he can help you with that. We do have something on the chat here. Awesome session. I love the part when he said that the 401 and the IRA would not do a thing. I so agree. Thank you so much, Romana, for that comment.
Thank you. Those are very kind words. I appreciate it.
Thank you. And now, Steve, we do have a question here from Kevin. He wants to know, Steve, can you elaborate on the single mom with twins and the strategy to own multiple properties?
Sure. What she did, she joined up and took our classes and was working with a coach. And she started off flipping. She was able to do a couple of flips, and the flips allowed her to generate capital to pay off her debt, fix her credit. I forgot to mention she had bad credit too. The flips allowed her to rebuild her credit, pay off all her debt. But again, flipping doesn't produce cash flow. So she then came to me and I started coaching her, and we started looking at apartment complexes. Now, these are small, 28 units was the first one. She's about to build another 20 units on that one. And then the second one was 23 units and like 40 units of self-storage. So her strategy was to begin by flipping, which generated enough capital. Then she partnered with other members up here at Total Wealth Academy. She put up some money. The members put up the rest of the money so that she could buy those apartment complexes and self-storage and that self-storage complex. Please tell me, Kevin, if that answer is clear.
Perfect. Thank you so much for that, Steve. We're awaiting for feedback from Kevin right now.
Okay.
We also have a few other questions already. Would you like to go on to the other questions?
Yeah, but watch out for Kevin because sometimes that
Oh,
answer
here we
is
go. Kevin answered it.
okay.
Great. I love how interactive this is.
Oh, I
Yes.
love these things.
Yeah. Now, Kevin says, yes, flipping takes a lot of money, though. Did she partner up with someone for that?
Her flipping, she did not partner, but the apartments, yes. See, that's why I'm glad he responded. Let me say it again, and I'll try to say it more clearly. Once she put together, she paid off all her debt. She kept flipping, generating 40,000 here, 80,000 there, 20,000, whatever, till she had over $100,000 in savings. Then she put up 100,000 and several other members partnered with her. Each of them put up 100 or 200,000 so that they could come up with enough money for her to buy that first apartment complex. She leads the deal. She's the sponsor or syndicator. And I hope that makes sense, Kevin.
Wonderful, wonderful. Now, Kevin says someone must have helped her flip.
Oh, no, no. She pulled that off all on her own. She is a dynamo, Kevin. But I'm telling you, so are you, Kevin. Um, I don't think that her first deal was, if you're using bridge loans, you can do flips for zero down. You can do rentals for zero down and so on. It's rare, but that's all she could do. So it took her a long time to do her first deal. I think it took her 3 or 4 months. But yeah, her first few deals, those flip deals, she did all by herself.
Awesome, awesome. Well, Yolanda Harris would like to know, Steve, what are your thoughts on tax deeds and tax lien investing?
I I got to tell you that I like all sources of deals and I hate all sources of deals. What I mean by that is some of them are good, some of them are bad. So what you don't ever want to do is assume that all tax liens are good deals, all tax liens are bad deals. No, there's some good ones in there. Just make sure you're running your evaluation correctly and you're not overpaying. Make sure you're getting written bids for repairs, whatever the circumstance is. Yes, it's a good source, but it can also be a bad source, just like any source can. And don't get addicted to one source. You're not going to find enough deals off of one source. I find deals through realtors. I find them through pre-foreclosures, divorces, you name it. Get as many sources as possible. They're all good and they're all bad.
Fantastic information, Steve. We do have another question from Anthony. Steve, can you please tell us how to reach you? And I'd also like to know more about your coaching.
Wow, that's a very kind question. Thank you. Yeah, the first thing to do is go to our website, which is totalwealthacademy.com, totalwealthacademy.com. And we offer a free sample class that you can watch online from anywhere in the US. And in that 1-hour class, I explain how the coaching works. The coaching, we have 2 levels, but if you're doing single family, you only need the basic level, which is $500. And we do unlimited question and answer with our coaches, and we'll walk you through your first few deals till you know what you're doing. I can tell you it only takes 3 or 4 deals before you know what you're doing. You know, people are like, oh, this is so difficult. No, you do 1 deal, you're a pro. 2 deals, you're a pro. I don't know what to call it when you do 3 or 4, because it's all cookie cutter, Linda. You know that. Once you do 1 or 2 and we walk you through 1 or 2, it's pretty easy.
Fantastic. Thank you so much for everyone's Great questions as well. We're getting some fantastic feedback from everyone. And RJ says, great presentation, Steve. You break down the 4 ways to profit from owning property clearly and easy for me to understand. Now, do you also invest in non-performing notes?
No, I don't, but I can't say I'm against it because I know I have some friends that do it and they're doing pretty darn well. But I do want to make it clear that my friends also own apartment complexes, senior living. In other words, they've got a ton of cash flow and they kind of do the note buying on the side. It's kind of fun for them. It's kind of like me having the 4,000 apartment units and still doing 20 single family homes. It's because single family homes are fun to me. It's like a little almost playing Monopoly.
Fantastic. Yolanda Harris says, thank you, Steve. Fantastic advice.
You're
Now,
welcome.
Kevin would like to know the single mom who did the flips, was she also utilizing private lenders and private capital? Is that some of the ways?
Kevin is absolutely right.
Okay,
Absolutely right.
great. I think that was the
I like the persistence of Kevin. Kevin, because you could have just taken the first answer. I like the way you question. You're a good learner, and the skill of learning is not something everybody has. So Kevin sounds humble. He's willing to learn. Man, you're halfway there. Keep learning, keep asking. But yeah, private money works.
wonderful. Now, Steve, I did already type in your website in the chat, so that is there. Is there another way that our listeners can get in touch with you? Um,
Yes. I forgot
okay.
to tell you, I do a radio show 7 days a week.
Oh,
When
great.
they're at totalwealthacademy.com, click on the radio tab and you can podcast the radio shows to hear it. But I also have an offer on my radio show, unlimited question and answer for anybody who listens to my show and has a question. So put my email there. It's just Steve at totalwealthacademy.com, Steve at totalwealthacademy.com. Any of you listening, if you fire me an email with 2 or 3 questions, I will personally answer it. I promise.
Wonderful. Well, thank you so much for being so generous with your knowledge, Steve. We really appreciate you helping our listeners. We are also live on Facebook, streaming, reaching thousands of our readers and fans and followers there. So we're really excited about that. This is the first session that we live stream on Facebook. So we're
That is
excited.
very cool.
Yeah. So we're really excited about that as well. Steve, is there anything else that you would like to add before we wrap up the session? Any last minute advice or
Yeah.
tips?
The last thing I would like to say is this, that every person that's listening to this can succeed in real estate. They can build a second stream of income. I don't care what your fear is, what your insecurity is. Maybe you got a low self-esteem and think you can't. I'm telling you, beat that out of yourself. You can do this. It may be tougher for you. It may be slower for you. But as far as getting to the end and getting that second stream of income or flipping or whatever you need to do to start, you can do it. And my favorite book on this to reinforce this is Anthony Robbins' Unlimited Power. So any of you that have, bear with me, a low self-esteem, you're sitting there saying, Steve's special, he can do it, I can't. You're wrong. That's a low self-esteem. Go read Unlimited Power by Anthony Robbins if you're saying that to yourself. And I think that will build you up, encourage you, and help you get a good belief in yourself. Because if you believe in yourself, you can do anything. I think it was Ford who said, whether you think you can or you think you can't, you're right. So let's get all of you in the position where you think you can read that book.
Fantastic. Once again, thank you so much, Steve. Kevin says, thank you, Steve.
You're welcome, Kevin. Thanks for the great questions. And thank you so much, Linda, for the opportunity. This was a lot of fun.
Wonderful. Well, it's always a pleasure to have you with us, Steve, and I look forward to hosting an event in Texas soon so that we can do this in person. I think we'll make such a huge impact if we do this in person. I mean, virtual is a lot of fun, but I just love shaking hands and greeting people and listening to their stories.
I agree with you, Linda. It was at events like you're discussing where I met people that changed my life in many ways. So I agree with you. And we got all the support you'll need here in Houston. You just say, we're coming to Houston and you can use our offices, you whatever you need.
Thank you. Thank you again. Hello,
Thank you.
Joseph.
Good afternoon or good morning to you.
Hello. Well, we'll be hearing from you shortly. We're just wrapping up Steve's presentation, but I'd like you to meet Steve.
Hey, Justin.
Steve, good afternoon. Good morning.
Good morning.
So once again, thank you so much for being here, folks. It's such a pleasure to have you. We want to thank Steve for all his amazing information and the tips and advice that he shared with us. It was really incredible. Kevin does have another question. Kevin, why don't you connect with Steve on the chat? I think he's still here, and if not, definitely reach out to him on his website. And there is a tab there where you can ask more questions. So for right now, we are going to start with our next session. We're really excited to have Joseph Scorese joining us with Lending One. And the topic of his presentation is how to leverage with direct private lending. And we're going to learn how to increase deal flow and profits by leveraging correctly. And it's all about leverage to gain that wealth, but we need to do it safely and correctly so that we don't get into trouble. And Joseph is going to touch upon some great information about what's going on in the financial markets as well. Joseph, welcome.
Linda, good afternoon. Good morning. Yeah, it's a pleasure to catch up with you. I see we have a couple professionals that I met at the 5-Star Conference this past week in Dallas. I do travel to a lot of the different trade shows throughout the country, such as yours, just because I like to keep that higher level of power team mentality building with the trade shows where you're meeting just more active and transactional real estate professionals.
Absolutely. It's great to network with people, and it's a lot of the way that business gets done. Now, Joseph, will you be sharing a presentation today, a PowerPoint?
No, I'm just gonna go freelance and then
Perfect.
obviously go with it. I know it's pretty cold. I teach a course on direct private lending and understanding differences between traditional lending, hard money, and direct private lending. I'm actually trademarking a book that's coming out hopefully sometime in the next month or so, called Leveraging Direct Private Lending.
Awesome. Awesome. Well, I will give you the floor entirely.
Sure.
And let you take it away. And then folks, you can ask Joseph questions just like we did in the last presentation. If you'd like to put them in the chat or in the Q&A, we will ask Joseph the questions after he's finished speaking. So thank you so much and take it away, Joseph.
Thank you. My name is Joseph Scorese. I am a direct private lender with Lending One, division of Blackstone Capital. I'm a regional development manager and I cover the Northeast, but I'm licensed in all 50 states. I provide a pricing engine portal for any type of real estate professional, real estate agent, and or mortgage broker or mortgage lender that needs a source for either their clients or themselves to price out loans, whether it's a rental loan, 30-year fixed, multifamily, 5+ unit or mixed use, 30-year fixed, or an ARM. And again, both of those can be ARM products as well. We also offer fixed to rent, meaning Burke strategy, buy, renovate, rent, refinance, redo, a one-time close. We offer fixed to flip. We offer new construction lending products as well. We have another product that's a portfolio loan product, which is more of a blanket loan type of environment, where we could blanket multiple properties in your portfolio, whether for refinance or purchase. And we could also blanket multiple bridge loans in the bridge lending space when you're buying and renovating multiple properties at the same time. We also have revolving construction lines of credit, meaning we look at an active transactional borrower and we multiply their assets 5 times and open up an account, say somewhere between $1 and $3 million, to give them more opportunities to do multiple transactions at the same time, meaning whether it's fixed to flip or Burke strategy. So I'm here to hopefully provide strategy and direction. And a lot of people don't really know what direct private lending truly is. And it's really its own true industry. It's only about 10 years old. It's hedge fund backed or insurance agent backed, agencies backed, where hard money is more of a private environment where more small groups are involved. The direct private lending is kind of its own lane, and it kind of separates itself from hard money, but it separates itself from traditional lending because most traditional local lenders can't provide 30-year fixed money or the type of leverage in the construction space that a direct private lender can provide. In the direct private lending space, on a bridge financing, whether Burke, fixed or flip, we could technically go up to 90% loan to cost on the purchase and 100% on the renovation. On the 30-year rental loan, we can go up to 80% loan to value, whether it's a refinance or purchase, as long as the property debt services correctly at 1.2 or better with that debt leverage. When it comes to new construction, our debt leverage can get up to 90% loan to cost on purchase and 100% loan to cost on the vertical construction. And again, that depends on the experience of the borrower. You know, the first several questions that I ask a borrower is, one, what's your credit score? We'd like to work with a borrower with at least a 660 credit score or better. We like to work with someone that at least owns their own home and one investment property currently in their portfolio. That does eliminate some of the newer investors, but I do welcome newer investors where I can manually put together that type of application. But I do still require home ownership where you must own your own home. And if you're buying your first investment property, that's fine. We're not collateralizing your properties. I just want to know you have skin in the game in the sense of home ownership. And we will then kind of go from there. We will look at your cash reserves, we'll look at your cash availability and see what you have available to leverage or participate into a transaction. But we also want to make sure you have the proper reserves, God forbid, of any contingencies, any shifts in the current environment of whether it's a construction loan or it's a rental loan. We want to make sure that you have some support from a reserve base, whether in your retirement or your savings, to make sure we're not over leveraging you and we're properly putting you in the right place. So direct private lender is more of a strategy environment where hard money is more strategic to one specific deal at a time because they have to do it that way. Not saying they're lending to own, but they have to look at the individual property because they have to worry about recovering that asset because their rates and origination are harder numbers. That's why the term hard money was created for that industry. For a direct private lender, the rates are a little less, origination is a lot less, where our minimum origination on any type of our loans start at $2,500. So that's really more of a flat fee, and then we go up accordingly depending on your experience in the past 24 months, especially in the rehab or renovation in space. Because we want to know in the last 24 months, have you done a renovation? Have you completed it? Was it profitable? And why? Supply chain, material cost shifts, labor shortages. These are factors that get us concerned that can you help, can you handle and facilitate the current market conditions? And as rates are moving up, traditionally now, a conventional loan rate closed on Friday at 6.70. So commercial rates right now are hovering around the high sixes, low sevens on a 30-year. You need to be able to pencil and evaluate your transactions harder and need to buy better in your transactions over the next 24 to 36 months. This is an opportunity for the investor to get in on a lower price environment and a lesser competitive environment from homeowners when rates were at 3-4% for them. Now their rates are at 6-7%, where I think there's more liquidity in the investor space. And there's a lot more money in the asset-based lending space. There's currently anywhere between $8 and $9 trillion allocated to this industry over the next 10 years per year. Lending One plans on deploying anywhere between 3 to 4 billion and or 5,000 plus loan applications to close each year for the next 10 years. So I'm here to hopefully provide any insight or direction. I just came back from one of the larger bank REO foreclosure asset manager conventions. I am leaving this weekend to go to Bigger Pockets. I'll be at that conference as well in San Diego. Obviously be in LA with Linda and Realty411 at the LA Expo, REIA Expo coming up in October as well. I'll be speaking at the Ohio REIA out in Dayton, Ohio, near Cincinnati, Ohio, at the Great Wolf Lodge. I'll be one of the key platinum sponsored speakers on Friday at the luncheon. I think we have an attendance somewhere around 2,000 people at that event. And I'll be talking about exactly what we're talking about here is how to better strategize and how to surround yourself with the right power team to grow with direct private lending. Because I think that's going to be one of the most important accessibilities that you need as a real estate professional, a real estate agent, a service, or a mortgage broker for that matter, when you need options for your clients. So I'm hopefully here to answer any questions, concerns, strategies, or directions. I hope I could be of any assistance at this point for any questions. I think I can. I'm a kind of individual that likes to give less is more, and then hopefully stimulate some questions from that.
Wonderful. Thank you, Joseph. Well, we'll definitely get to some questions. Just to let you know, we do have RJ who met you last week at the 5-star. He says it's great to see you again. And also another, Jay Miller says, hey, Joseph, we know each other from 34 years in New York, New Jersey.
Yep, I was actually, irony enough, it's not I guess it's a good irony, Linda. So about 15 or so years ago, maybe a little longer, 17, 18 years ago, maybe, I was part of a REIA called Big Apple REIA. And the gentleman, Al Johnson, he got sick. He had a stroke, actually. And he didn't recover as well as I did as a stroke survivor. And I had to take over that REIA for a bunch of years. And that's how I got myself running a REIA, by kind of like somebody taking ill. And it kind of got me exposed to a lot of the New York and New Jersey real estate professionals that are out there. Then I've been to thousands of events, and I've run or coordinated events on behalf of other REIAs throughout the Northeast region. And then I've did, during the pandemic, we did over 600 podcasts, Yardell Perkins and myself, who's my social media strategist. And then now we're just trying to keep up with trademarking a trilogy of books that we're leveraging out. One is leveraging direct private lending. One is leveraging social media in the real estate industry. And then obviously the last one would be something a little different, leveraging networking in the real estate industry. How do you properly network and get follow up and follow through when you meet someone at an event or a function such as Realty411 or any type of event? How is the follow up? What is the protocol? And I'm gonna put a nice short book together and how I feel it's worked for myself. And I've seen some successful tombstones from it as well. So yeah, I know I see some relevant names saying hello, and hello to everybody else. And I do look a little different probably since some of them have seen me, because I'm officially 135 pounds as of today, Linda, less than when I had the stroke. I was 351 pounds. I weighed in at 215 this morning. So I've actually lost another 10 or so pounds since I saw you last.
Wow. Congratulations, Joseph. We all know how difficult that is to lose weight and keep healthy. Incredible. So
Well,
congratulations on that as
thank you.
well.
Yeah, and then I own currently 9 multifamily buildings. One of the buildings is where actually Donna, who you got to meet, my wife, she's actually having a grand reopening of her wellness center and school for massage therapy as we speak in Philadelphia at a building that I own at 4th and Vine. And that's a 9-unit. I own currently a 25-unit multifamily. I own 2 14 units, 2 12 units, a couple 5 units, and then a 5-unit mixed-use storefront, all in the northern New Jersey market. I've owned hundreds of properties in the Delaware Valley, Lehigh Valley markets, whether new construction, renovation, full guts to the studs, single family through 4 family or multifamily ownership over the past 25, maybe 30 years. I've been a licensed realtor since '88 in New Jersey and PA. I'm officially CE approved and authorized to teach classes for real estate agents now in 5 states: New Jersey, New York, Pennsylvania, Delaware, Connecticut, and all 5 states there. And then I teach part-time a couple times a year at Temple University at the real estate school as well.
Wow. Well, you're just so busy and have such a diversity of educational things going on. So that's fantastic, Joseph. Now, in your experience, Joseph, what are some of the mistakes that investors make when utilizing private capital for their deals?
Great question. I think what it is I think people, investors want to make deals work. And there's no such thing as a square peg going into a round hole. So you have to use the numbers of what they are, and you have to use contingencies, especially when there's unknown repairs. If you're not using 10 to 20% contingency to whatever your general repair costs are and adding another 10 to 20% cost to buffer your numbers, you're not evaluating your deals correctly. And if the deal doesn't work, you can't make it work. You can't also make up a value of an after repair value. And you make money, obviously, when you buy. So the goal is to pencil your expenses correctly on the debt service coverage ratio, which I provide anyone with a debt service coverage ratio worksheet to use to better understand their debt leverage when they hold the property out. I also provide a Mayo sheet, which is called maximum allowable offer, where you could actually evaluate your deal at 65% LTV based on the after repair value. Now, you did hear I go up to 70 to 75% LTV based on R, meaning I go up to the after repair value 70 to 75%, and then I'll leverage money on the purchase and the rehab. But I like to evaluate my deals, mine personally, at 65% LTV, because I want to give myself some room, 1, for negotiation, 2, for a depreciating market right now. We're going to start seeing numbers start coming back down. So I'm going to take some precautionary measures to evaluate my deals better, because you make money when you buy. Okay, so you make money when you buy, and you have to evaluate accordingly. And if you don't mind putting my direct cell number in there as well, Linda.
Of course.
215-290-5108. That's 215-290-5108. I mean, if you want to text me, your full name and your email, I can send you the worksheets. If you want to have a strategy talk, if you want me to set you up a pricing engine where you could actually evaluate your own deals. Now, if it doesn't come back through the pricing engine, don't get disappointed. Text me, call me, say, hey, Joe, the numbers didn't work when I ran my numbers. Why? Then I'll give you a call, go over it. Maybe it's something because of your experience or the lack of experience or the leverage or the type of renovation costs. Another mistake a lot of people do, they try to take on too much repairs on their first acquisition. They do lopsided rehab deals, I call them. They're lopsided, meaning you buy it for 75 to 100 grand, but the renovation's 100 grand. That's 100% of the purchase price. That risk is extremely high now. That is, if I was a newer investor starting off in my renovation experience in my quest, I try to keep my renovations below 50% of the purchase price. So hypothetically, if I'm buying something for 100 grand, I want to keep my renovations under 50 grand based on the acquisition cost, because there's less concern of recovery of that asset that I'm going to foreclose on you, and a better chance of you completing that asset to either flip or stabilize. And time kills deals. So if you don't move on that project, you're eating away the only thing that's there for you, which is the profit and or equity in that project.
Great insight. What about the feds raising the rate 0.75% this week? How is that going to affect the real estate investing game right now and, going forward for the rest of the year?
Yeah, most direct private lenders have taken those costs into account, and there's probably going to be another 3/4 hike as well. Where I see the biggest impact, that's going to be the cost of credit. The bank costs, meaning traditional banks it's going to cost more money working with the banks and holding your money. Material costs, whether it's material for the actual transaction of building material, there's going to be some impact there. Inflation, what the media and the government is telling us, and what their true inflation rate is about a 5%, 6% variable. They're telling us around 9%. I'm seeing inflation somewhere around 14 to 16%. So, who's really telling the truth at this point? What you have to do is be smart about it. This is a huge opportunity and pivotal moment in where real estate values are going, and the opportunity for the landlord to grow while there's resentment for home ownership at an all-time high. 50% of your homeowner buyer today is a millennial. Half of that buying power. Half of those or more, if they don't have to buy a property, they would rather rent and allow somebody else to take care of their environment, controlled environment, from a renter perspective. And there is trillions of dollars available for the investor to get in, as long as you're qualified. So make sure your financial resume is ready, specifically credit, cash reserves, and availability, and you have home ownership. These are some tools that keep in mind that I wouldn't get caught up in the interest rates. I'd get caught up in the debt service coverage ratio of the cash flow of any individual property that you're buying. If it doesn't work based on cash flow, the rate could be 15%. I mean, the first property I bought, my rate was 12.5%. I bought a 4-unit. I still own that property today. It's now a 5-unit, but I still own that property today. And that 12.5% never bothered me at the time because I bought it correct.
Wonderful. Tell us a little bit about the different programs that Lending One has available for investors, please.
Yeah, sure. So the pricing engine will allow you to evaluate, refinance, or purchase 30-year fixed and or rehab loans, whether it's fix and flip or fix to hold. Anything else like multifamily, mixed use, the revolving construction lines of credit, new construction, you have to have more of a strategy talk with me to see how you qualify, does the actual asset qualify, and what that scenario will look like. I will look at some other type of commercial type of projects, but again, it's all going to be case by case. Every project, every asset has a whole different engine block, and I have to look at that individually. I just can't look at 20 different deals at the same time. I just had a client, he owns 14 different properties. We took a global of his debt service. We took an individual debt service to his individual properties. What are the next moves that he needs to make? Because some of his properties are in his personal name, some of the properties are in the LLC. It's like, Joe, which way should I go? I'm having debt to income issues. I said, let's go the asset-based lending route. You got to make sure you have the proper corporate veil. Obviously, working with somebody that knows how to set up your corporate veil, having the 4 most important items when you're getting into lending. One is the LLC, obviously, and you got to have your EIN letter, your articles of information, your certificate of good standing, which you're going to need every year from the state, and obviously a signed and dated operating agreement. Even if you're sole individual in the LLC, set yourself up with an operating agreement, because God forbid something happens to you, somebody needs to take over that asset or assets in that LLC. So somebody needs to have accessibilities to that operating agreement and know how to operate the LLC, whether to close it out, sell it off, maintain, whatever the point may be. God forbid something happens to you.
Now, do you lend capital in all states, Joseph? And what areas do most of your investors what areas are they coming from, most of them?
I'm licensed to do a loan in all 50 states. The only island in Hawaii we can't lend on is the volcano island. So the island that has 2 volcanoes, we're not a fan of lending on that. So I think we're okay for the most part. I don't really have a location. I'm more concerned about value or loan amount. I do want to keep my loan amounts above $75,000 and my values on refinance or purchase turnkey at 120. If it's below that, we got to have a discussion. On my construction side, I want to see a construction purchase minimum of 100,000, and then whatever the renovation costs are. And again, if it's below that, we need to have a individual strategy discussion and see where we can take that correctly, because I want to make sure you're stacked correctly on that, on the purchase, the repairs, and then the after repair value. On the turnkey or refinance type of scenario, I just want to make sure we're properly putting you in the right program based on that loan size. We don't really have a ceiling. We don't have a ceiling on the amount of mortgages you can have with us or loan amounts. I don't think we have that type of concern since we're owned by Blackstone. So I think I haven't seen a loan they've turned down based on size. How about that? Not yet, at least.
Wonderful. So this is a great opportunity to reach out to Joseph, ask any questions you have about lending, finance, how to leverage correctly. This is your time. So if we can help you, please let us know. And just to let you know, Miss Jay Miller is now in Florida. He wanted
I see
to
that.
let you know.
Moving all over the place. She's going to cover the whole country for us at some point.
Wonderful. Joseph, can you share with us a little bit about the Clubhouse group that you also host, and the show that you host on Clubhouse? Because it really is fantastic as well. And I'm going to be putting a link on because you're speaking there tomorrow morning, correct?
Yes. So I started the club just under a year ago. And you try to get your footing in class. It's a lot to take on, understanding Clubhouse. Once you go in there, you're seeing all these clubs, these groups, and like live events as well. There's also the very questionable groups and organizations. And you got to be careful because there's predatory individuals everywhere. And trust me, there's there's a lot of predatory individuals on Clubhouse as well. So I decided to create my own club. I vetted the moderators. As you know, Linda, I'm very careful who I allow in the moderator's booth. They need to be vetted. They need to know somebody within my circle. And I keep my circle extremely tight. And we have had some really powerful discussions. Now, I used to be on there more often, but my position just doesn't allow the timing. So I've committed to every Saturday morning, 8 a.m. Eastern Standard Time, and every Sunday morning, 9:30 a.m. Eastern Standard Time. I might guest spot in a couple different rooms for other people that I like and respect and have a relationship with. But I'm very careful because I like to have a very unique subject matter. We come up with very unique subjects every Saturday and Sunday. I try to highlight some of the moderators as well with what they're doing in their current environment. I'm very happy that I've built some really great relationships. And I look forward to seeing more of my relationships in person at Bigger Pockets, Realty411. Like when I was down in Dallas, I ran into probably a good half a dozen individuals, real estate professionals that knew me from Clubhouse. So it's like, it's all coming together. which is so unique. Meeting people, via audio, and then all of a sudden you get to meet them in person. So I was at an event, I think it was a week or so ago, and I go up to a young lady. It was in Reading, Pennsylvania, of all places. I had some airport networking event. I go, "Hi, my name is Joe Scorese. I'm with Lending One." She goes, "Oh my gosh, you're Joe Scorese from Clubhouse." I said, "Yes, I am. How are you? Nice to meet you." She goes, "My goodness, your voice and you're like, you match up with your voice." I said, "Well, I hope so. Am I taller? Am I smaller? What am I better looking in person? Am I photoshopped? I mean, like, what's?" And she started laughing. She gives me a big hug. She goes, "I love listening to you every week. You're so direct and nice at the same time." I said, "I don't know if direct and nice all complement one another, but I was raised by two very Italian-born mother and father, and rules were pretty set out very strictly in my world. And I guess I don't like a lot of story. I like a lot of bullet point facts. And I think I think you got that from me when we hung out. You obviously know that my wife is the softer side of the relationship, and it's worked for me. And I'm the kind of real estate professional, and I think I translate that on Clubhouse. I pull the Band-Aid off. I don't dilly-dally around. If I'm going to give you news, I'm going to give you news right there. It could be good, bad, indifferent. You could take whatever news I provide you in the room and take it whatever way you want. You might not like it, but you're going to hear it. And I think that's what I love about Clubhouse the most is I'm able to provide concise, direct information. And I don't think the populace of the room and the attendees are insulted in any way. They're very appreciative of the directness. And I try to give as current information as I potentially can, because I think some of the rooms are probably 3 to 6 months behind in news content and real stats, where we're probably staying within the last 30 days or more immediate information for investors or professionals to grab onto and hopefully apply to what their strategic plans in their real estate goals.
Fantastic. I'm going to go ahead and put the link for the chat for the Clubhouse group. That way you can join Joseph tomorrow morning at 6:30 Eastern time. He does
8:30, 9:30,
9:30 Eastern time, 6:30
your time.
Western time. Yes.
Yep.
So Pacific time. So it's a great group, and they do give some fantastic nuggets. I went ahead and put the link on the chat. Now we do have some questions. Anthony would like to know, Joseph, how can you help a buyer investor with a non-rehab property?
Meaning more of a turnkey.
Yes.
So, Anthony, in regards to that, we need to look at the debt service coverage ratio worksheet of how much can we leverage based on the current income and expense of that subject property and the units within it, whether it's a 1 to 100 units, whatever it might be. So the debt service coverage ratio, depending on what rate we plug in, will determine where the leverage allowability will be. Now, if you own your own property and own at least one rental property, if I set you up on a portal, it will give you an immediate quote and leverage on that scenario. Excuse me. So the portal through Lending One is immediate. We don't need to run credit, but you just pop a credit score in there. You pop it the scenario, it'll let you know what they'll able to purchase upon, depending on your experience in the past 24 months, rental ownership, etc. If you don't own any rental properties currently, you're going to need to contact me directly. As long as you own your own home and credit's above 660, I could then put together potential terms with a pre-approval letter if it's your first deal out of the gate. I can't hear you.
Fantastic. And Rafael Martinez would like to know, do you also do second loans?
No second position loans at all.
Okay.
Whether refinance or purchase.
Fantastic. So folks, I did put the link for the Clubhouse group tomorrow that Joseph will be monitoring and hosting. He does a fantastic job. Again, it's at 6:30 a.m. Pacific time, 9:30 a.m. Eastern time. We also added Joseph's cell phone number, which is 215-290-5108. If you would like to have a conversation about your deal or deals, or would like to run a scenario by him, feel free to contact him with more details on that. Now, let us know if you have any other questions. Our Q&A and our chat is open. Anthony would like to say thank you for answering his question.
Thank you very much. Thank you very much, RJ. Nice seeing you again via the webinar here. And that's the beauty of this stuff. You know, you will run into people. You know, when you're nationally trying to make relationships and creating strategy ideas with like-minded individuals, there's no such thing as luck. It's karma. Like Linda, you and I have been meaning to run into each other, I think, for a decade.
Yes.
And it was just because we were introduced by a colleague of ours years ago, Carl Chavone, but it kind of never ever came together until, I don't know how did it all come together, but we came together and had a great event together. And now we're going to have another great event again. And we had this event together, and now we're doing Clubhouse. And I look forward to a very frothy opportunity in the 2023 market with you as well.
Well, thank you. Same here, Joseph. And Joseph and I had the pleasure of being in Fort Lauderdale. I'd say about a month and a half ago, we had an event there. It was wonderful, met some great people. And we look forward to hosting more additional events around the country. We're planning some for 2023. I've been invited by Amy, you know, Amy on Clubhouse. She wants to have an event in Austin. So
Okay.
we're speaking as well. So, you know, we love to meet investors, and we're all about helping people. We want to help you get that deal under your belt, whether it's your first one or your 100th one. You know, we're here to help you, and that's what we're all about. Joseph, do you have anything else that you would like to say?
No, I mean, listen, there's a phrase that's from Denzel Washington that I kind of live by. You know, you hang out with 5 smart people, you become the 6th. You hang out with 5 millionaires, you become the 6th. You hang out with 5 idiots, you're going to become the 6th. So pick your choice. Which one would you like to do? Who do you like to hang out with? Those 5 people. So think about that and how that sinks in when you hear it, and say it to yourself, and you'll separate yourself from the herd and be the fish that goes the other way, and let the rest go. The rest of the school of fish go the other way.
Fantastic advice. Thank you so much, Joseph. We really appreciate your time. We're thankful for you sharing your knowledge, and I would encourage everyone to reach out to Joseph if you need help with your financing your deals. He's here to help you. We have RJ saying, I'd like to hang out with Joseph. I'm hanging with Joseph. And Mike says, good morning from Ontario, Canada.
Good morning. Good morning. Good morning. And RJ, I'll see you soon. I'm sorry I was not, Linda, you know what the irony? I went down to Dallas, right? I went and got an IV hydration the day before I went, right? Great, felt fantastic, but I must have had the flu in me. By the time I got down to Dallas, by the time Monday came, I must have sweated the Saturday night, Sunday night, Monday night. I was really not feeling well. I lost my voice. I was like talking like a frog, but I still hung in there like a trooper. And I mean, I'm never going to take an IV hydration before I go away on a weekend again, but it was definitely a learning lesson. Now I feel fantastic a week later, and I'll go back for another IV hydration. But yeah, I was not feeling my regular self in Dallas. That was the only thing. I met a lot of great people, but I think I could have met a couple more if my energy level was there. It just was not there. I had to go to bed by like 6:30, 7 o'clock every night. So it was That was the only negative thing about Dallas. I love Dallas. Great place, great people. Everybody was really engaged. Everybody wanted to get to know each other. And I look forward to seeing you again this month coming up.
Absolutely. Folks, Joseph is joining us in Los Angeles for our LA Grand Expo. Last year, we had close to 700 investors from around the country, especially from California, both Southern California, Northern California, as well as Central California, where we're based. It was an amazing event, and I'm going to go ahead and also share the link with you in the chat for those of you who can join us in Los Angeles next month on October 22nd. I would encourage you to do so. You'll have a chance to meet with Joseph. You'll meet me. You'll meet a lot of other investors from around the country and from around California who are making the deals happen, who are actively engaged in real estate investing. And you're going to learn from people who are doing it day in and day out. We encourage you to do that. It is a complimentary event. So guess what? You can use the money that you would have spent on a ticket to spend that on your travel, airfare, and your travel expenses to get over here and join us in person. We are not live streaming the event. We are not going to be going virtual that day. It's all in person. So I hope that you can take the time out of your busy schedule to join us in Los Angeles, the City of Angels, October 22nd at the LA Grand Expo. Joseph, I can't wait to see you again. It's going to be great to network with you in person that day. And I'm looking forward to connecting you with a lot of people that I know so that you can help them with some finance.
Look forward to Linda. You have a great day. Be well. Everybody take care of yourself and be blessed. I'll hopefully see some of you on the streets of Clubhouse maybe tomorrow morning.
Thank you again so much for your time. We appreciate that very much. And say hello to Donna for me.
I will. Be well.
Thank you. Wonderful, folks. So that was Joseph Scorese with Lending One, Joseph B. Scorese. Connect with him. He has so much fantastic information for you. And guess what? He has the capital that you need to make sure those deals get done. That's what it's all about. We want to connect you with the power players, with the people that have the connections, the funding, the knowledge to help you. So we do have some time. And with this in mind, I would like to bring on Jason Burke, who has helped me with events for many, many years. I first met Jason when he attended our event in Los Angeles. Remember that, Jason?
Yeah, I remember that. I went to the LA Expo back then, and yeah, Mark dropped me off, and that was the first time we met. So I definitely remember that.
That was 12 years ago, folks. We've been hosting events for over 15 years. I met Jason about 12 years ago when he attended in person our Los Angeles event. He drove all the way from Las Vegas with another gentleman to join us with Mark. And that's how we met. So powerful things happen when you meet people in person. And as I mentioned, virtual events are fantastic. We love them. We love hosting events like this. But when it comes down to doing business and, exchanging money, a lot of money, I would recommend that you meet people in person. There's no better way to really gauge the business and the company and the individuals that are going to be making the decisions. So with this in mind, Jason is going to be sharing some tips on how you can host your own virtual event or your own in-person event. And you may wonder, well, why would I want to do that? Well, guess what? If you're an investor and you want to raise capital, there's no other better way than to meet people of influence and to meet wealthy, high net worth individuals than by hosting events. You can host very elite, private VIP events with only a few people, or like us, you can host complimentary large events to bring a large group of people together. It's up to you. Um, there's a lot of different ways of hosting events, and we're going to learn a little bit more information about this with Jason. Jason, take it away.
Thank you so much, Linda. What I'm going to cover today is about how to host your live events and then how to monetize them and also save money. So what I'm going to cover first is one of my favorite strategies. It's called the venue sponsor strategy. And this strategy is really good, especially when first starting out or have a budget. A lot of companies will have training rooms. And those training rooms, they're willing to give you it for free or low cost, providing you can show them value. Like giving them a couple minutes to speak at the beginning of your meeting. If it's an expo summit event like this, that's a live event, have them as a featured speaker. Promote them on social media, promote them through your email database, have them on a guest on a podcast or a television show. If you have a magazine or newsletter, feature them in an article. These are all ways to add value. And as you add more value, they're more likely to continue hosting events at their location because they get a benefit. And this will save you thousands upon thousands of dollars compared to hosting them in your hotels. So I suggest you definitely make a list of at least 10 companies you know that have training rooms and see how you can structure a deal that works to host your events. Now, I want to get into how to save money in your hotel meeting space cost. So whether you're planning your monthly meetings, you're planning a summit or expo event, first thing you want to do is pick about 5 to 10 locations that you want to host the event in the city you want to host it in. Then what you want to do is ask the following questions. What is the slowest days of the week? And the reason you ask this question is because you're going to get the best price on meeting space, the best price on food and beverage, the best price on AV cost. You might even get some free sleep rooms because keep in mind, you're driving business into the hotel in a day where it's slower, where that room would be empty. And that gives you more negotiating leverage. So asking that question with each of the hotels is important. The other question you want to ask is, what's the food and beverage minimum to get the meeting space for free? And you want to compare the food and beverage quote versus the meeting room rental quote without the food and beverage and see which is cheaper. Sometimes the food and beverage quote can be cheaper. The reason is the hotels want to drive their business to the catering departments. And doing this, they're willing to give you the space for free if you drive the revenue to the catering department. But comparing two quotes will save you money. Our landmine to navigate is the hotel room block. A lot of hotel room blocks, especially when doing summit, expo, or larger conference events, will push the room block. But just be aware that as an event organizer, for any of the guests that don't use the unused rooms, you end up having to pay because we learned this lesson in 2018 at a high performance assessment event. We got stuck with a bill of thousands of dollars of unused sleeping rooms. So this is why I suggest to avoid that. One, if you're going to have a hotel room block, have it expire within 30 days and have it written into the contract that you're not responsible for any of the unused sleeping rooms the hotel can't sell. This will save you money. If you're not going to do room block, do a percentage discount. Let your guests know they can get a percentage discount if they book their sleep rooms directly through the hotel. But the hotel can continue to sell the sleep rooms, which is really important. This will keep you out of losing possibly thousands of dollars in profits. In the wrong hotel, it can be tens of thousands if you're dealing with 5-star resorts. So that was some tips on saving money in your hotel meeting space cost. And I want to talk to you a little bit about how to save money in your AV cost. If you're doing events locally, having a projector screen will save you some money, basically. That's some equipment. Just be aware, sometimes if you're bringing in your equipment to hotels, there's union and non-union hotels, and you may not be able to bring in your own AV gear. And here are some basics that will save you money on AV. For example, Wi-Fi. A lot of hotels and AV companies will charge per connection on the Wi-Fi connection. So knowing the number of connections you need, don't give them a ballpark range because they'll bump you up on the price tier because they have tiers of pricing. So they'll bump you up on the tier if you're not specific. And know what speed you need. So if you hear superior or simple Wi-Fi, it simply means faster or slower. Another thing that will save you money is on technicians. A lot of AV companies will charge you for techs in the room on an hourly basis. Now, if the setup or breaking down after midnight, it's time and a half per technician. If it's the holidays, it's 2x. Knowing this will save you money so you can make sure you coordinate when they're setting up and breaking down. Well, next, I want to talk to you about how to really get 30% to 50% off your AV bill. And there's a couple of tips with that. One, be prepared in advance of the top 3 to 5 areas you want to save money in. And what you want to do is you want to sell the vision of your bigger conference. So if you're having a small meeting or a medium-sized meeting, but you have a bigger conference later in the year, you want to sell the vision for them to be able to compete for that business. Because the AV company will be more willing to give you discounts on a small event or a medium-sized event if they have a shot at landing the bigger event. So you want to sell that vision. If you're a newer company, you want to mention like the celebrity names you have and speakers you have, because that will show the credibility you have. If you're not a large corporation or organization, especially as real estate investors, you may be 1 or 2 people or a small company. So you want to leverage off other celebrity speakers you have, because when you're selling that vision, it'll help you drive down the price. Another way is you want to build rapport with the person that you're talking to on their end. So if you're a solopreneur or a small organization, I highly recommend you study DISC, which is the different personality types. So you know how to relate to different personality types. And the last part of that formula is really knowing situations that will save you the most money. Like knowing the slow seasons from hotel and AV companies, this will save you money because during the slower seasons, they're going to be more willing to give you discounts and concessions. The last 10 days of the month, the last 10 days of the fiscal quarter or fiscal year are also a place where you can save money because a lot of AV agents are trying to hit their quotas or make their bonuses. So if you're selling them the vision of be able to bid on the big event, plus you're helping them hit their numbers, that's going to be another bonus, and that's going to help you drop the price. So you can save anywhere from 30 to 50% on your AV costs if you're building the right rapport, you're selling the vision for your bigger event, and you're showing them the value of it, which is really important because the more you save on those costs, the more profit you keep in your pocket. One of the things I want to talk to you now about is how to monetize your events. And there's 4 ways that you can monetize your events. The first way is sponsorships. Sponsorships are a great way to monetize your events. The main thing with sponsorships is you want the following. You want to structure your sponsorship packages where your most expensive sponsorship gives them the most value, the highest speaking time, the best speaking spots, the best exhibit placement, the most social media, the most exposure, the most email marketing. So that your highest level sponsorship gives your sponsors the most exposure. You may want to think of structuring it as a yearly sponsorship because you may want to help them create their goals, or you can structure it as a per event sponsorship. So your highest level is going to give them the most value. And then as you go down the levels, they'll get a little less value and a little less value. But in each level, you want to stack the value. So what's valuable to sponsors? Naturally, speaking time is valuable. Premier exhibit space is valuable. Social media promotion is valuable. Email marketing, name mentions, and swag and materials throughout the event. Also, if you can have them on a guest on a podcast or a TV show and get them out there, name recognition. Exposure is very valuable and promotion is very valuable leading up to the event, featuring them on your website and collateral materials. You want to build in the value to your sponsorship package so your sponsors get the maximum value for that. And the more value you give them, the more perception of the value, the more the prices will be up. It's a great way to monetize your events and help cover your cost. Another way is ticket sales. Ticket sales are a great way. The key with ticket sales is your highest price tickets are going to be usually your celebrity give your audience the most interaction. We've had thought leaders and celebrity speakers, the most social events, most social gathering experiences, because you're really selling the experiences and connections your audience is going to make with well-known thought leaders in your space that you're holding the event with. And that's going to give you the ability to charge higher prices. And then as you go down each level, they'll get a little less and a little less. Now, if you're doing a free preview event or you're doing a free event, just be aware the show-up rate is usually 30 to 50% on average. So for example, if you have 1,000 registrations, you have 300 to 500 that actually show up. If you have 300, you actually have 100. Especially when you're doing like preview events, coaching events where your audience is coming for free because you have an offer on the back end. You want to know these numbers and be prepared for that. Another way to monetize your event is selling your own coaching products and services. Not only will this drive revenue for you at the event, but it'll set you up for additional speaking opportunities, whether that be live stages, virtual stages, podcasts. These are all opportunities that can drive additional revenue in the future. So you're making revenue at that event, but you're setting yourself up and positioning yourself to make more revenue in the future. And then lastly, having other companies sell their coaching products, programs, services, and get an affiliate commission is another great way to make revenue. That's 4 ways right there to make revenue from your events and to monetize your events. And since we have time, I'm going to talk a little bit about how to select your speakers, book speakers, and book big thought leaders without paying through the nose to do so. When selecting your speakers for your events, you want to make sure that their topics resonate with the audience you have at your event, because you as the event producer know your audience best. And as you know your audience best, you know what's going to resonate and what's not. So you want to set up that speaker that's going to be in the best position and that your audience is also going to get the most value. Now, if you're allowing them to make an offer from stage, you also want to know the price point that they're going to be charging, because you know what converts from your audience and what doesn't. So, for example, if your audience is used to paying $5K for coaching, you bring in someone that's charging $100,000 or plus, it may not convert well. Where if you have a higher end audience that used to paying say $100K or above, and you have a product that's $500, it might not convert as well. So you need to really know your audience and what converts from stage based on past events. And if you haven't done events before, you want to lean on an experienced person that has to get advice with that, because that's going to be important, because you want to set up yourself and the speaker and your audience for the best experience possible. Now, people that sell coaches or companies that selling from the stage, you want to know when you're getting paid out for the commissions for those events, because every company is different. Some companies are a couple days, some speakers are 45 days. It depends on the refund policy. So you want to have that clearly in writing. You also want to know the percentages. That can range from anywhere from 5 to 50%, just depending on what you negotiate with the company. An experience when you have 10, 20K coaching programs that are higher, that usually goes anywhere between 5 to 20%. We have programs going between 500 and 5,000. It's usually 50%, give or take. So you want to be aware of that, and because you want to set yourself up and you want to know as an event producer when that revenue is coming in, which will really set you up for multiple success with your events. And I want to talk to you a little bit about how to book big thought leaders for your events, because we all want celebrity and big influencers at events and our events for free. But we do that by developing a relationship first with them, by adding value to them first. Because if you develop a relationship by having them on your podcast, inviting them on a virtual event, creating value first, they're more likely to come and speak at your event for free or low cost. But if you have to pay, for a lot of cases, you are going to have to pay for the travel expenses or the speaker fee, and sometimes both. And here's some questions to ask yourself to see if that's a good return on investment. 1, how many sponsors are we going to attract because this person's speaking at an event? How many ticket sales are we going to attract because this person is speaking at an event? If they're selling from stage, how many back-end coaching sales are we estimating, or product or service sales? Is there a chance to do a big event with this person and build it to the future? There's a chance to do a bigger event. You might be willing to take a short-term loss to build a longer-term relationship First, if it's a one-off transaction, you have to make it based on the numbers. But you want to ask yourself with that, because when you're paying speakers to come in and speak, you got to evaluate the ROI, return on investment, and what is your organization's goals, which is a clear thing. And you evaluate that, that creates a good experience, not only for you, but only for your speaker. You have the right expectations bringing them in. You know the value they give, and you know the value you're providing them. And it creates for a really great experience. Again, I want to thank Glenn for giving me the opportunity to share some tips on live events. And what I'm going to do is I'm going to put my contact information in the chat, and I'm offering everyone to book a free 30-minute event mastery strategy session with me, Jason Burke. You're going to find my information here in the chat in a few minutes. Again, I want to thank Linda from Realty411 for giving me this opportunity to share my knowledge and information with everyone here in this great audience.
Thank you, Jason. Thank you so much for sharing your knowledge about hosting live and virtual events. And folks, you can't imagine the power of hosting events, live and virtual. I've met some incredible people that have helped me in my business, in my real estate deals, in my life. I mean, they've become very good friends, like Jason. Jason and I have become really good friends, and he's helped me with my business. I've helped him with his business. You know, and that's what it's all about, folks. It's about relationships, because the more positive, influential relationships you have, the better you're going to do in your business and in your life. So with that in mind, thank you again, Jason. I really appreciate you.
You're welcome. I appreciate you too, Linda.
Thanks again. And with that in mind, folks, we're going to go ahead and go on to our next speaker, who is a gentleman I admire greatly, Dr. Chander Mishra, MBA, with Blue Ocean Capital. We're going to go ahead and get him on now. Dr. Mishra, can you join us? There we go.
Yes, yeah. Hey,
How are
thank you,
you?
Linda.
Now, Dr. Mishra is with Blue Ocean Capital, and he talks a lot about mindset, which is so important when investing in real estate. Dr. Mishra has invested in multifamily properties. He likes to invest in the Texas market, which is a fantastic place to invest. And Dr. Mishra, what are we going to learn from you today? What is your topic going to be about today?
So today, of course, I'm going to teach a little bit about multifamily, and also I'll share our current offering. So it happens to be that we have an open offering at this time. So I'll share a part of that too.
Awesome. Well, folks, this is great. Not only are you going to be able to learn about multifamily properties, but you're actually going to have the ability and the opportunity to take action on a multifamily property. So that's what it's all about. We're giving you opportunities, knowledge. So go ahead and take it away, Dr. Mishra. Will you be presenting with the PowerPoint today?
Yes,
Okay.
I will start that, and then I will start sharing.
Thank you.
And screen, there we go, share. So here I am, and we'll get started. I hope everyone is having a great day today. Thank you very much, Linda. It's always a great pleasure to come on these events and share. There's a reason why I share this. So there are three phases of our life, and more I learn and I grow. So first phase, we are learning, and we are learning, and we used that learning till 25, 30 years, maybe some do a little bit more. As physicians, we stopped learning in real sense by 35, 36. So we are a little bit late in the line. But in general, when that stops, you not only learn at that point of time, but you learn and earn. And then we come to a phase where we practice what we call it learning, earning, and returning. So you return it back to the society, community, and to other people. So this is like a great way Linda has put together to return to the community. It's like she brings all these great people who come in here, they share their knowledge base, and they return it. So everyone can take some bit of action, gain a little bit of knowledge, and not only that, have a resource to act. Means I'm so grateful for all of you and for Linda and this platform. I cannot even express it. So I'm in that learn, earn, and return phase. I have been doing real estate investing since childhood, and that's how I really learned how to kind of like pay for our expenses and grow. And in fact, some of you might think it's strange, but I really did not know anything about stock market till 2003, 2004. So, and I've been living for about half a decade. So I'm about 52 years old. So that tells you something. We actively investing in multifamily since 2015, 2016, but in real estate for over 16 years here. And this is our website, blueoceancap.com. This is our phone number, and I'll get started. So the reason it says discover a way to add passive monthly income to your generational wealth. Few things. One, it is not a quick rich scheme, you know, so anything you learn here is not going to make you richer over next 24 hours. It's not an option trading strategy. It's not a crypto strategy. It's not a Forex strategy. And the reason I mention all that is because I've done all that at some point, just like all of you, and it hasn't worked out for me, primarily because as you all are very busy professionals, and we pick up a strategy, we go, we follow it, we are gung-ho about it, then after a certain point of time, we kind of let go of it because we don't have time, we can't put in enough effort, so on and so forth. Now, this strategy works very well for people who are busy professionals, who are physicians, who are, or who just want to put a little money on the side. But it grows, it multiplies, and it amplifies. So let's move further in this. So this is a journey of a physician, and the reason I show this chart is because it makes sense. Because one of the common thing is that yes, we are going to earn a lot of money, and probably put our money-making machine at a higher roll. Let's burn it, churn it. And what happens is that in a physician over 30 years, let's suppose you are earning $300,000 a month, you end up getting like to $1 million. Post-taxation, and these are kind of average calculations. It may vary a little bit. You will end up with $4.5 million of your earnings in the next 30 years, and which comes out to about $150K per year, and about $12,500 per month. So I wrote here why doctors are broke. It can be anybody else who's in the same situation, high-paying executives, tech, financial people, so on and so forth. But expenses are ramping up. So they ramp up significantly. The insurance goes up, your house and car payments go up, utility. I could not believe I was just paying like close to $700 for just for the utility bill. Food, you already know there's 11 to 15% inflation. There's education expenses, so on and so forth. Not to include vacation, clothing, family, and other liabilities like education loans, which kind of like tack up. So the answer is we have to shift. One is, where is the shift? One is we can create. So these expenses, largely if you're in a single household, will stay consistent, but you can add extra passive income. And if you can decrease your tax and other liabilities, that works for you in a long term in creating a lot of money for you, your children, your grandkids, so on and so forth. So, and what really stands in our way from having our dream? Basically, we always say the time is not right. So for example, like right now, there's a lot going on in the market. There's a lot going on in the world. There's a lot of stuff on the move. So what does it mean? Means that, do you feel stuck? Do you feel at one place, you are waiting to take action, so on and so forth. You may not have enough money at this time. I hear a lot of this from the recent graduates. So people, hey, I'm just coming out. I have a ton of loans. I have to do this and that before I get to this. Lack of knowledge. I don't know anything about this. And maybe that, hey, I don't have that much time or health or capacity to go ahead and do this. So there could be a ton of things. There could be fear, doubt, worry, anxiety, so on and so forth. Multi-gazillion things kind of working in against you to not take action and not have your dreams. So the key is like, how do you get rid of them? And the simple way, I will say, I won't go too much into it today, but a lot of the things, once you become aware of it, you can let go. So once you know that, okay, this is what's stopping me. And Linda has done such a great job here by bringing all these people. I was looking at the speaker lineup and what they are teaching. Gosh, somebody could have told me all that like 30 years ago. I would have been at a very different place today. So all of you who are here today has already made that shift, that change, or you are already at a much better place than I was many, many moons ago. So you are so smart in taking that action. But you can even go further by letting go of your fear, doubts, worries, scare, concerns, and kind of moving forward and going and charging at it. So I will share this, the Falls and Oak Village offering. This is a multifamily offering. You would say, okay, how does this get constructed? What people can earn. So these are the offerings which are brought to you by different sponsors who find these properties, who get these properties into a contract, do all their due diligence, go to the bank, get the loan, find a third-party PM to manage it, and basically a whole lot of construction crew to go ahead and make the changes and do the upgrades on these properties so we can boost the rents. And there's a lot of significant amount of work which goes into it before we go. So this acquisition is close to 55 million, and I'll walk you through it. But you can be a part of this by investing anywhere above $100,000. And you really don't have to do that, except you really don't have to do much more than that, apart from being a part owner or a kind of like a financial partner in this situation. So let me walk you through. So this is a disclaimer. This information here is confidential and is solely used for providing information and education for the prospective investors of the Falls and Oak Village Apartments. While the information contained here in this presentation has been compiled from the sources we believe to be reliable, none of the representatives make any representation or warranties as to the accuracy of completeness contained here. All financial information used in this presentation and projections are provided for references only based on assumptions relating to the economy, market conditions, and other factors beyond our control. All references to acreage, square footage, and other measurements are approximations and must be independently verified. Investors advised to make investment decisions after reading PPM and subscription documents provided. This is the 506C syndication open to accredited investors. So I had to read this, and this is kind of like part of the slide, and it's a disclaimer. And I want you to know that I'm not a financial guru, nor I'm an attorney, nor I'm a CPA. So this is our usual agenda, but this is our group. So this group, this is me, my wife. These are our partners, Joseph James. Joseph is a great person. He runs another company called ROI Muse. Tony Anthony is a VC, and Gori Mankamo and Amit Darnole, highly accomplished people. And so what I'm saying, it's a team sport. So at any point of time you want to become a sponsor, you know that it's not just one person's game. There's a lot of people who are involved in this business, and there's a team of people who are involved beyond this. There's a lender, there's a tax firm, there's a legal firm, there is a property management firm, there is a equity people, there is a capital partners, so on and so forth, by which you kind of get to put all this. So what's so important about this property? This property is in Dallas-Fort Worth. That's usually my playground 90% of the time. So this is a 409 units community, which was built in 1980s, and some part of it was in 76. And it's in a great neighborhood in Fort Worth, attractive yields from day one, plus substantial upside potential, primarily from the ancillary income streams, utility savings, and effective management. There is some opportunity on the management side, and I'll tell you why. Market rents are close to, in this area, close to $136 per square feet. I had managed a property very close by and owned it, and I sold it in January at rental rates of $1.49 per square feet. More than $5 million has been kind of invested in this recent capital improvement. It's a Class B quality asset with pitched roof, individual HVAC, washer dryer connections in over close to 90% of the units. And there's a significant upside and a lot of amenities which are in there. So what have we done till now? So as you know, we have invested in 10 of these. This is the property Maribel Apartments, which I sold in Fort Worth. We own a bunch of them others, Las Lomas, Parkland Point. We still own in El Paso. Swing Hill Village in Houston, we still own. Carriage Place, we just sold, made a great return for our investors. Candlelight, we just sold too, made a great money for our investors. And as you can see here, we have sold all these. Apart from these, we own about close to 700 units portfolio in Dallas-Fort Worth area. And we continue to grow this. With this 400 added on to our portfolio, we would be close to 1,000 here just in Dallas. So we got our LOI accepted. We did a PSA. Effective date was July 13th. And once we got our due diligence completed, we did a webinar on 15th. And this deal is open to subscription. And there's a very short subscription period, about a month, and then we are going to close it. So what's happening in the markets? Markets in the stock market, it's kind of like very shaky. So we all know it's shaky. The stock market is basically, no one knows what's going on. It's very speculative. People think there's a bubble. The bubble is, we don't even know on a daily basis what's happening. The workers have gone back and to homes, and 65% of them don't want to come back. And they may not even return back to the office. Now, this has been the interesting point, is there was a drop over 530 points. This was right when we did our presentation, and Feds keep increasing the rate. NASDAQ and Dow plunged over 530 points, and NASDAQ plunged over 3% as the inflation reports hit. The CPI continues to go up. They say 8.3% to 8.5%, but in the market, the cost of the food and goods have gone above, close to 10 to 15% for the people who go and shop. And did I know this today? No, I knew this about 6 months ago. And here is an interesting portion. So where do you really park the money? And the part is, if you park the money, in a bank, you're losing 10 to 15% of it each year, just plain because of inflation. Now, just so you know, we got this property under contract, and we have been talking about this property since the month of May. So now coming to this point of it, we have already gained 8 to 9% extra value, primarily because it's been about 6 months. So in 6 months, the inflation has kicked up, and the property pricing in general has shifted up primarily. Now there's a downward pressure too on it, on the pricing, primarily from rising interest rates. But on the other hand, it hasn't resulted in that much of a trouble, primarily because we have the advantage of the increased market demands of housing because the rates are going up, people can't afford the homes. So they have to have a place to live, and that place is going to be apartments. So why invest in multifamily? So there is an advantage of cash flow. It means these properties are already there. We improve them, they're cash flowing. We can improve the value of the property by forced appreciation. There is, just like I said, it's like a small community. There's 410 units there. There's significant tax advantages by doing cost aggregation studies. There's a resiliency in volatile markets. And of course, you can use professional property management, and that's why we can scale and grow. So not as fast as buying 20,000 shares of Apple or Microsoft, but you still have an ability to scale it. And this is very interesting graph which I use. And this data is from 1993 to 2013. The key to notice here is that you can get good amount of stock, a good amount of money in large cap, small cap, and even commodities to a certain extent. But look at the annualized total return here. So if you see the annualized total return, where it is around 9 to 10% in the large cap stock and real estate. But look at the risk. The risk in any annualized risk is very super high, like 20%. So if you do a risk adjusted rate of return, if the way I look at it, if my risk is 15%, let's suppose on the lowest side is 15%, and my return is 9% or 10%, let's suppose, then 15 means 10 minus 15 is minus 5% on an average return over a long period of hold. So at any point of time, I carry that risk that, okay, my portfolio can vary between 5 to 10%. Forget about the economic collapse and other stuff which we see in high inflationary periods and other changes which the Feds are doing. Now with real estate, even if you take a 4% or 5% risk, you have an average return of 9%, and you minus the risk, there is an advantage of about 5%. So what I'm pointing out here is that not saying that real estate is better than stock market, but I'm just giving you a logical framework that why there's not much variation in the output. So if your baseline stays constant and each time you have a step up, you are going to make more money. While if your baseline goes up and down, then it takes you longer to regain that money back, and you're wasting time as you compound your money, and the compounding is not that effective. Now, why only apartments in the commercial real estate? So if you look at the mean and standard deviation and the Sharpe ratio is effective, like we talked about, the return compared to the risk in apartment is much significantly higher. While the standard deviation 2.81%, 9.05 is on an average performance. So you can gain as high as 12%. You can gain as low as, and this is plain data. This is not the data which is kind of like we are making. This is the data which is available out there. So what about this one? So this investment now, it's mostly like a high return, mostly at the end of it, because you have got 5 to 7% cap, 5 to 7% preferred return built in. So if you see, we have a 409 units, and the reason you see this 409, it's basically 410 because the seller is building one more unit and is going to complete and give it to us before we buy it. It's 19, you have a 48.6 million of purchase price. On the top of it, we have a 4 million of budget to improve it. We have some, so the bank is giving us the loan to improve the property, plus another close to 32 million. And we're raising $19 million of equity. The loan is a bridge to perm loan with non-recourse, with minimum investments, as you can see, 100,000 to 150,000, which are different share classes. With the LPGP split of 80-20, there's no waterfall. It's a straight split. And entry cap rate for the people who pay attention to these, 4% and 5.2%. What you earn, it's a 2%, 2x multiple cash on cash, based on if you put in like 100,000 to 150,000, you get bonus depreciation of 75% of total investment. And if you look at IRR, the IRRs are say 17 to 18%. So you have a significant return on these, on this investment, and that's what is exciting. So in this kind of environment, when the whole thing is melting down, if you park your money and you wait for 5 or 6 years, and I will tell you that if you need liquid money, don't park in these investments, because once money is in, the investment has to run its course for the money to get out. But on the other hand, if you park your money in, you're going to see cash returns, plus you're going to see the extra money at the tail end of it once this property is disposed of. So like I mentioned, it's not a solo play. You've got our company who is kind of partnering with all these different people to get it. It has a lender, cost sec firm, Kelly Clark, the attorney, syndication pro is our investor platform, McElwain and Associates, and Class A Management is our PM firm. So what's happening in Texas? For all those who are out of Texas, I know California already knows more about Texas than Texans do, but look at the third quarter absorption and fourth quarter absorption. Third quarter absorption in Dallas-Fort Worth of the multifamily, huge. The demand was 26%. Of all multifamily demand in the third quarter. So it's pretty much a great demand in this market. A little bit about the area. So you can see here is the property. It's close to ton of, it's in Fort Worth, and ton of employment base. TCU, Fort Worth main district, medical district there, Ridgemar Mall, ton of local retail. There's a Lockheed Martin Joint Force Base, Reserve Base, and other things which you can see on this side. On the other side of this, on the west side, you have this huge development of 3,790 acres, and there's a Walsh Ranch, which is twice this size. So they say the size of this is approximately half of the Manhattan. And it's very important to know how much growth is there for the property to have people who need the workforce housing, and it's important to pay attention to those things as we invest. So what I'm talking about is I'm just sharing you some of the factors which we have already looked at. I'm cut the number of slides just for the virtue of you understanding the presentation and what we need to look in when we go and invest in these properties. We want a good product, we want a good location, we want it in a place where there's a job growth, rent growth, so on and so forth. I'll tell you a story which I shared with someone who is kind of very, very well versed in real estate investment, and they kind of shared their life in it with me, in the sense that they said they were used to building some new homes and giving them in rentals, and they built it in the area where there were more newer homes going on. So these people came in and they kind of got into those rentals, and they have built them brand new. So they were able to, of course, they gave a discount for them to get in because that's what you do. But on the other hand, a couple of years later, this population was looking to go to another similar place. So they had to put in back more money to get those places up. And the same thing happens with a lot of us. I have a lot of physician friends. When they go and buy their first rental or want to invest in a rental, they go and buy a new home in the latest new kind of development. But the problem is 2 years or 3 years later, your home now looks older, and comparatively, there are 3,000 more homes to be bought because now there's more buildup around there. So always be very specific, because what you are renting, when you buy something for rental, and it took me quite some time to understand that you are not getting it for you to live, you're getting it to rent. So you have to buy it in an area which supports the growth, the population growth, and the demand that has to be there. And there has to be a job growth so people can pay your rent. So this is Walsh Ranch and Wheel Ranch development I talked to you about, but this is the most exciting because this is like 72,000 acres. This is 11.4 square miles, which is nearly 1/3 of the size of the Manhattan. 770 acres for corporate and commercial use, 32 plus miles of hike and bike trails. So all this is just 5 minutes from there, from this property. Wheel Ranch, just development going right there, 5 miles west of Fallen Oak Village. What is the demographics which supports it? About 2026 projections, 5-mile radius, 156,206. 3-mile radius, the average household income 73,000. 2022 Q1 DFW median home price is 361,270. So now the challenge is that as our tax rates go up, as our inflationary interest rates go up, it is becoming more and more difficult for people to go ahead and buy these homes so they can support their family. There's a huge chance that instead of buying, people are deciding to rent. And that's the only way to go because they cannot afford to buy a home in this situation. So a little bit more about property description. This tells you the idea, what's going on there. 409 units it's the whole size is about 22 acres. So it's a pretty large property with 18.5 units per acre, very low density, a lot of mature trees and shrubs, mostly flat. And the roof was recent 2017. You can see there's 16 3-bed, 2-bath. There's 28 2-bed, 2.5-bath townhomes. There's a 2-bed, 2-bath, 65 units like that. 2-bed, 1-bath is 64. 1-bed, 1-bath townhomes are 4. 1-bed, 1.5-bath is 28. 1-bed, 1-bath is 188, and there are 16 studios. So the key to understand here is there's a multivariate plans to have an availability for different types of people who are coming in to rent here. So this is some of the exteriors. And again, for the people who are listening, this is an existing property. This is kind of very interesting. I present a property and always get this question, when do you start building it? This is not to be built. This is an existing property. This is a cash flowing property, so on and so forth. So these are some of the post-renovated units which we are planning to put in. As you can see, nicer floors, backsplashes, black appliances. We have nicer cabinet poles, hardware, two-tone paint, and nice baseboard, so on and so forth, framed mirrors and fixtures. They all kind of like change the look of this whole unit. So what's the future look like? So this is the rent trend, as you can see. The properties in blue. So this is where the opportunity is. And if you look at the South West Fort Worth rent, 1 to 3 star, the rents are, this is the mean rent, overall asking rent per square feet is $1.36 to $1.40. In general, in Dallas, you see overall this market 1 to 3 star is going to close to $1.50 per square feet. This is another one. It's about depicting the same, similar idea, but overall effective rent. And you see, like this shows typical challenge with PM, like effective rents has been up and down because the PM has not been able to maintain this consistent slope. And this was your COVID period, so it took a little dip, but then it's on the face of recovery. So when it's on the face of recovery, this is the best time to come in and grab it because they put in the money, they've done the hard work. Now you have to just boost the management, do some renovations, and go from there. So this is for the 100K investment, and you get 5% pref, and then you get the rest of the money at 175K at the tail end of it. Post closing, we do provide you monthly reports. All investors will receive, progress summary, occupancy, balance sheet, cash flow, T12 financials. Distributions, expect first distribution after 6 months. Quarterly distributions after that. Regular communication and frequent updates. We believe in transparency and open channels. This is how you invest. You can go on my website, blueoceantap.com, and blue there's no E in it. It's blueoceancap.com. And if you click on the current offering tab, you can go there, or you can even scan this barcode and this QR code, and this QR code will lead you up there. This is more like, this one is only open for 506C investor, and that's why I can share these details with you here. We would need an accredited investor form, which you can get from a third party or from a CPA or an attorney. And some people who just like to have the long URL, this is where you go and you sign in and go from there. So this is what it is. So this is kind of like in general, the anatomy of a deal. And there are people who do this for you and bring you back to a well-packaged deal to you where you can invest and where you can profit from it for a longer period of time. And this is how you continue doing that. And this is how you grow your money and your ability to leave more wealth for your future. And with that, I will be happy to answer any questions. And
Dr. Mishra, we're right here.
here we go.
Sorry about that. I had some back issues with sound, but here we go. Jason, do you have any questions for Dr. Mishra?
Yeah, what would be like you would say the top 3 keys for people, for investors that want to invest in multifamily to be successful, and maybe the top 3 things that landmines they should avoid stepping into?
One is know the sponsor. Okay, that's the main part. And this, because if you know the sponsor, it just takes care of the rest. Because if a sponsor is, when I say know the sponsor, means you know the sponsor, you know their style, you know their investment, what happens when things go wrong, how do they manage when things go wrong. Because and the second part is know that it's an investment. It's really not like a guaranteed return bond family kind of product. So you're going in investing in a real product. And in that real product, the good part is most of the time you don't lose your money. And it's kind of like, I say that because in any product you go in and you invest, you always have that chance. But on the other hand, you need to make sure that the knowledge of the sponsor, availability of the sponsor, and the markets and the way they invest is the key. So that's number one. And that's the second is the market. So just like you read on stocks before you invest, you should read that market. Okay, how is the Dallas-Fort Worth doing? Or how is this market doing? What are the projections, where it will go, so on and so forth. And the third part is knowing that this is not a very liquid investment. It's becoming more liquid by having a lot of third parties now, which will kind of liquidate, but there's more chances that you won't get the full value of it.
And we do have a question in the chat. Jason, would you like to facilitate that?
Yeah, that's fine. Absolutely. Let me look at the chat. Says Dr. Mishra, do you have any requirements that need to be met to invest, especially for first timers?
Yes, so there are 2 kinds of offerings. One is accredited investors, which is like 506C and 506B. So the one which I showed you is the 506C offering. So there you have to be an accredited investor, and that's one of the criteria. It means you need to have over $1 million in net worth, or you should be making $200,000 as an individual, or $300,000 as a joint husband and wife per year, and reasonably expecting it to make it this year and make the same this year. So you have to get that certificate or have that declaration and then give us the certificate at a little bit later date to invest and accredited investors. But there's another one, 506B, is where you need to be a sophisticated, where you don't have to provide a certificate, but you need to know about that kind of product, that kind of like what you are investing in. So you need to have a very clear-cut understanding. So if you're investing in a 506B offering, make sure you read the PPM, you read the markets, you read all the product which has been provided to you. And I would even say that just follow someone for a couple of their deals and then invest. So that way you get to know them. But for this one, in short, you just have to be an accredited investor and provide a certificate of that.
Wonderful. Thank you, Dr. Mishra. Now, we also have another question from Kevin in the question and answer queue. And his question is there any advantage for a passive investor in a down market versus an up market? And the reason he states this is because he says it seems there would be plenty of advantages for the syndicator to buy more properties, but not for a passive investor. Can you elaborate on this?
So, and that's why I said in the beginning, know your sponsor, know your syndicator, because how they work, if this is like a fee-heavy syndication, then the syndicator may benefit, but you realize that you going in, getting the properties at a very good price and making money on it. It depends where you park your money. So if you park your money in the stock market, it takes a dip, that's not an advantage. For a syndicator in all the syndicated deals, if you compare it with another syndicated deal and comparing between a syndicator and a passive investor, I think both benefit from it, because deals like this, which are structured 80-20, like 80% of the profits go to investor. This is with no waterfall. These are very lucrative structures. So when you look at the structure like that, and you know it's pretty much fairly set up where investor is going to benefit more, then it's always like a go, you know. While you still get, this is the last year, 2022, when you get 100% bonus depreciation. That's also one of the reasons why passive investors should invest, because you get a ton of bonus depreciation on the top of it. And other part is you are a little bit more protected as the inflation grows or curbs down. No one knows, but you're a little bit more protected on your investments, and you have some dollar which is not losing that much value in sitting in the bank or in the open market. So that's what I think, but each one of us have our own views, and only do what you're comfortable in doing, because I would not, these are just my personal views about it.
Fantastic, Dr. Mishra. Just to let you know a little bit, tell us a bit about how you started your journey as an investor. Did you start off purchasing single family investments before the multifamily, or how did that come about?
So I've been doing this from childhood. So we used to buy land at the edge of the city, wherever the city was growing, and basically we sell it after a couple of years after building, and then we started building on it and selling it that way. In US, I did the same thing. I brought land. The only single family homes which I have purchased are my own residences. I haven't done much of single family homes. I've done a few fix and flips, but they were in partnership. I have done condo developments, bigger developments where we purchased land and we worked on that project to develop some condos. My first multifamily investment was one passive investment, which was like 340 units in Arlington. And my first indication was 120 units candlelight, which you just we sold like last year, and we made over 25-30% per year on it at the LP level. So yes, I've been fortunate enough to directly jump into multifamily game compared to the single family.
Fantastic. And what do you foresee coming up with the multifamily niche and sector?
So I basically tend to stick to one sector because I'd rather do something very well than spread myself based upon different things which are going on. The demand is still going to be high for a couple of years. The rent growth is also being projected by most people to be higher, primarily because the higher tax rate will push people to rent more and for a longer period of time. And if you focus on the prime markets and prime areas, I think there's also the value there. Price adjustments because of the higher interest rates have already happened. So I don't think that that will be a bigger issue.
And we do have some comments in the chat. Let me get to that. Jay Miller said, Dr. Mishra is awesome. We met at a fund launch event in April.
Yes.
You remember a Jay Miller?
Yeah, she's wonderful. She's doing a lot of projects all across the country, and it's a combination of a lot of philanthropic work, and she's a great inspiration for a lot of people, and a lot of bringing in a lot of cutting edge technologies for our seniors and everyone else, and bringing it together at one place so people can experience the living and rejuvenation and all that in one place.
Awesome. Well, that's fantastic. Now, Rumana also would like to ask you, Dr. Mishra, do you have any requirements that need to be met in order to invest in a deal, especially for a first timer?
Just be an accredited investor and take your time to read through everything.
Okay. Okay. And then Alex would like to know, does the 75% bonus depreciation mean that you would reduce year one taxable income by 75,000 on 100,000 initial investment?
Yeah, that's a very good question. Before I answer, I'm not a tax professional or a CPA or a tax attorney, but what it is like you have that depreciation available for you to use it to offset any other passive income. That's how I understand the best. So if you are a real estate professional, you can offset an active income.
Wonderful. Is there anything else that you would like to add, Dr. Mishra?
Well, I really appreciate you, Linda, and all these great people who are basically here Friday, Saturday, and putting this seminar together where people can learn so much. And this is really fabulous. And even if you don't do anything, just take one step, do one thing, listen to one thing, follow one thing, and that one thing will change the trajectory of your life over a period of time. Just pick up one thing and just execute. I'm not saying that follow it all. I'm just saying see what resonates with you. And there's so many good people here, and just learn something from them. If you don't learn anything, learn that even on the weekends, you can create so much change for others. So just help the person right next to you, and we can create a better world.
Wow, that was wonderful. Such great advice.
Well, thank you very much.
I really
Thanks, Linda.
appreciate that. Hold on one second. Before I let you go, I want to try and show people something if I can. I'm trying to find it and show it on the screen. One moment, please. Let's see if I can do that. Zoom is, even though they make it very user friendly, it's still a little bit tricky to execute, but here we go. I'd like to show everyone, ta-da, Dr. Mishra and Iva Mishra on the cover of REI Wealth magazine number 59. Can you see that, Dr. Mishra?
Yeah, thank you very much. Appreciate it.
Yes, we are so excited that we are promoting you on our new issue. It's our new REI Wealth magazine, and we're really excited about it. Let me go into the article itself so I can show people here. One moment. I'm trying to find it here. It's a big publication. We have a lot of fantastic articles. Oh, here we go. A lot of fantastic articles and information. And we feature Dr. Mishra and his lovely wife and tell his story. So we're just, really excited about it. And it's a great article. We'll send a link. I'm going to post a link in the chat so everyone can read it. It's now live and available. We are going to press this coming week. I'm doing a last minute review of, grammatical errors and just copy editing it. So I'm doing a last minute review of everything and then we're going to press. So I'm going to type in the link here so everyone can check it out and read Dr. Mishra's story. Here we go. So you can find more information about Dr. Mishra and read his story in that magazine, REI Wealth magazine number 59. Dr. Mishra, it's always a pleasure to have you join us.
Thank you, Linda. It's my pleasure. Thanks a lot.
Thank you. And
Bye-bye.
Jay Miller says congratulations to you. She wanted me to pass that on.
I appreciate it. Thank you. Thanks, Jay.
Well, great, everyone. And I want to thank you for joining us at Realty411's Virtual Investor event. We're so excited that you're here. And our next speaker is an amazing gentleman that I had the pleasure of meeting and working with on several projects. First off, he spoke at one of our live events in Dallas, Texas a few years ago. He made such an amazing impact at that event. He also brought in Robert Allen at another event, and we invited everyone at our event to attend Sunil's event with Robert Allen. So that was amazing. And then he's also has spoken at several of our virtual events. He's also appeared on our cover with the amazing Robert Kiyosaki. So I'm delighted to have Sunil with us live in person joining us. So let me go ahead and make sure that he can start his video. Sunil, how are you?
Hello, Linda. Thank you very much for having me.
Well, thank you so much for being here, Sunil. It's always a pleasure to have you. And for those of you who do not know, Sunil is a former police officer turned real estate investor. He leads, and he's also an author, by the way, and he leads the largest and most elite real estate group in Canada, Private Investment Club. We did already post a link to his club in the chat so you can learn more about Sunil. And Jay Miller says, hashtag Sunil rocks.
Thank you, Jay Miller.
Hashtag clerking, which I don't know what that is.
I will. So good. That means Jay has, I met Jay at your event, I think for about a year or maybe a year and a half ago. So I recognize her very well.
That's so amazing. And that's what I love about our network is we meet people across the country and even internationally. Our private group has investors from Israel, Australia, London, Italy, Greece. It's amazing. And, we eventually get to meet everyone in person, or almost everyone. Our goal is to meet everyone that we're connected with socially on media, on social media. Um, and that's what it's about, folks. It's about connecting with influential people. And that's what Sunil's going to be touching upon today. So, with that, Sunil, go ahead and take it away. And it's a pleasure to see you and have you on as always.
Thank you, Linda. I appreciate it. I just wanted to confirm with you, how long do I have so that I can plan properly? I know I came on a little earlier.
No problem at all, Sunil. You can go ahead and take up to 12:15, which will be our break. Then we'll have a 45 minute lunch, or you can go on till even 12:30, and we'll have a short 30-minute lunch. So
approximately 30 minutes. I have about 30 minutes.
wonderful. So we'll take that, and we're thankful for your 30 minutes.
You're welcome.
you.
You're welcome, guys. Everybody, hello. I know there are people here on Zoom, and there are people on different type of social media. My name is Sunil Tulsiani. I am founder of the largest elite real estate club in Canada, which extends to United States, Asia, UK, Europe, all over the world. And I'm very blessed to be able to do this because we are in amazing times right now. It is crazy time for majority of the people, and it is going to be the best time for some small group of people who are going to make more money than they have ever made in the upcoming months and even years, because we all know, they're all still talking about whether we're in recession or not. We are in recession, and then it's thank God for social media, and nothing is really hidden if you want to find this information. And so those of you that I get emails, contact, phone calls, and all that stuff, we're very worried about real estate because they bought some properties or they think the big crash is coming. And I agree with, crash has already happened in many areas of the United States, many areas of Canada, and even globally. And I truly believe it's going to continue, and we are in some tough times. But when I say that to people, most people think that I'm trying to tell them bad news. And it is, I guess, kind of bad news for a lot of people. But as my friend Robert Kiyosaki, we shared stage in Japan, Tokyo, Japan. And when I was there behind the scenes, when I was having a private meeting with him, he said that he made more money in 2008 than he had ever made prior to that year. So he made more money in 2008 and 2009 than he had ever made before. And I asked him, what was one thing that he did? And that's one thing what some people can do if there is a tough times coming along. And he said, line up your money. Now, you've heard a lot of times people say, oh, just go get a good deal and you're going to get money. It does happen occasionally. But what Robert Kiyosaki did was he lined up $300 million while everybody, when the market was going up, saying that market's going to keep going up. He predicted the market's going to crash. He has predicted this market is going to crash. I'm predicting that as well. And like I said, it's already started. It's not a secret anymore. So lining up your money should be your goal, because it doesn't matter how much money you have. You always want to be able to line up your cash buyers, your people that you can assign the deals to, people you can partner up with, your money partners, down payment partners, what have you. So that is what I'm going to talk about today. So if making lots of money in real estate is important to you, by the way, real estate is a business. So it doesn't matter if you want a coach, mentor, author, you have other type of businesses, and you want to grow to the massive levels, you always will need money. You need capital, you need connections, and you can do that right now. You should start doing that now, because let's say in 3 months, 6 months, whatever, it gets really, really, good time for you to buy good deals. You lined up your money, you're going to be able to walk in and buy those property cash like I did in 2008, 9, 10, 11, 12, 13, and onwards. From Canada, we ended up, us and our team and our members ended up buying about 1,000 properties in United States from Canada. Why did we do that? Because they were on sale. It was like a mall. It's like a real estate mall going on sale. And so I want you to know, for me, I've seen since once I left the police force in 2005, just over 17 years ago, one of the things I experienced was markets were up, markets crashed, markets were flat, and market came back up, and then again, markets coming down. So I've seen them, and I know I'm very prepared. So first of all, preparation is important, education is important, and then your mentors are important, your investors are important. So right off the bat, I'm going to give you something that is really, really important. I just released a book called Achieve 2, and this is with my friend Robert Allen and Kevin Harrington of Shark Tank. It's called Achieve 2. Just became a bestseller a few months ago. And those of you who want this, I'm going to gift the digital copy to you. If you want the physical copy, you can have it as well, as long as you pay for the shipping cost. But you can have the digital for free. You can have the physical for free, as long as you pay for the copy. In here, how to achieve money freedom, how to attract investors, how to connect with center of influences, and how can you avoid certain mistakes. This book has become one of the top books, and I'm very blessed to say that. It's called Achieve 2. It is on Amazon. You can buy it there as well, or you can do this. So how do you win it? You just simply send an email to admin@privateinvestmentclub.com. It's actually in the chat box. I don't know if people can see it or not. If team can put it up, that would be great. It's admin@privateinvestmentclub.com. And what you do is you send an email right now, and in the subject line, all you say is Achieve 2 and say Realty411. So I know you're coming from Realty411. My team would know that, and they will actually give you a free copy of this book. So that's number one. Number two, I have this, it's called Confidential, and it's from my friend Kevin Harrington, the original shark from Shark Tank. And here, there's so many strategies. There's so many strategies how to raise money. So one of you is going to win that. It's I think it's like $300 or something like that. So if you want to win it, again, send an email to admin@privateinvestmentclub.com. Now, I'm doing that because I want you to know that a lot of people say to me, Sunil, yeah, but it's so easy for you to raise money. I'm shy, don't have the confidence, don't have connections. Maybe you do, maybe you just don't have the big contacts and connections. And I want to tell you, growing up in a poor family in India, no running water, low electricity, and no toilets. And I went from there to coming to Canada in 1981 when I was about 13 years old. And then in 1990, I became a police officer. And then for 15 years, I was a police officer, a uniform officer, became a detective, became a police negotiator, and finally a platoon commander. And because of the family reasons, in 2005, I let that go and I became a real estate investor. Now, the reason I'm telling you all this is that I was a shy guy. I'm introvert, shy guy, low confidence. People told me you're not going to amount to anything. Go study hard, get some good grades. If you don't do it, then you're not going to be successful. And I believe a lot of those people growing up. So now, fast forward 17 and a half years later, I've shared stages to Tony Robbins, Grant Cardone, Robert Kiyosaki, Robert Allen, Robin Sharma, Deepak Chopra, some of the top people on the planet. And I've become an international public speaker, 7 times #1 best-selling author. And the reason I say that is that if there are things in your mind you're saying, I can't do it, you don't understand me, Sunil, or I don't have that attribute. Yes, you can do it too, because I was the guy that wanted to just make money for myself. No, I wouldn't do any of these things. I was not a public speaker. If somebody had asked me to get up and speak for 2 minutes, even at the marriage or some sort of party, I would be sitting in the back. That was the guy that I was. So what can you do right now? One of the things you need is to build your confidence, and that confidence can be built by starting with small things to grow. And one of the concepts that I talk about, and I'm gonna, by the way, I have a wealth mastery event coming up next week in Toronto with Robin Sharma, a person who wrote Monk Who Sold His Ferrari, Kevin Harrington, Michael Tracy, Brian Tracy's son, Michael Tracy. And one of the things that I talk about is connecting with COIs, Center of Influence people. Because when I left the police force 17 and a half years ago, there was one center of influence that changed my life completely. A center of influence is somebody who's well-connected, who has access to people, who has access to money, who has access to Rolodex, who can actually hook you up with what you need. That's what it is. So a lot of people go to events or they do things like that and they connect with the attendees, and that's fine. You should do that as well. But one center of influence can change your life and your business and your cash flow and your generational wealth forever, which happened to me. We have generated millions of dollars since then. And I teach this all over the world, center of influence. So how do you connect with center of influences? Because center of influences have one thing that they do not have. What do they not have? They do not have time. They don't have time. They, especially for somebody who's a stranger that don't know them. And if you're not successful yet, you're not well known yet, well, they get thousands of people coming to them saying, you know, could you work with me? Could you coach me? Could you lend me money? They get that all the time. So those strategies are not going to work. And if you try that, you know it doesn't work. So what will work? What works is creating a lose-win situation. I keep talking about this lose-win situation. People say, oh, we understand it. But then as soon as they meet me right off the bat, they say, oh, Sunil, I love you. I'm your fan. Would you lend me $1 million? And that's not what I mean by lose-win situation. In that case, the center of influence is losing, you're winning. When I'm talking about lose-win situation is that you lose first and they win. So what does that mean? It means figure out what they want. What's important to them? How can you help them? What do they need? What can you do for them? Maybe they have an event and you can volunteer. Maybe you can help them in some way. Maybe you can help the charity. Maybe you can help write for them. Maybe you can help edit and proofread for them for free. So do something so then you become known to them and your generosity. So you give first in order to get is the important part. And then center of influences are investors and high net worth individuals, some of the top speakers, coaches, mentors that you all have heard, the people that I just talked about. Now, today I do business with Jack Canfield. I do business with Brian Tracy. I do big business with Robert Allen. I do business with Kevin Harrington of Shark Tank, you know, and I'm bringing Grant Cardone next year, Kevin Hart, the movie star Kevin Hart. So these are center of influences for me. And now a lot of them have become my friends. And these are the people I used to read their books. So if your mind says, but not me, nobody's going to do that with me. The truth is I was like the same. I was the same way. So line up your money right now by connecting with center of influences, by creating a lose-win situation. That's number one. Number two, go to center of influences events. Go to their events virtually, more importantly, personally, in person, if you can go there. Go to their events, number two. And when you go to these events, if you can, buy the most expensive ticket if they have different level of tickets. Why? Because as you get closer and you buy more tickets, chances are the center of influence is going to be, maybe you're going to have lunch with them. Maybe you're going to break bread with them. Maybe you're going to spend some time with them. Those are the people the center of influence are going to naturally notice. Think about it this way. You wrote a book, right? You write a book and you're in a crowd room full of people and there are 10 people who buy your book. And then the other 90 people say, well, we love your book. We love you, but that they don't buy your book. Are you going to spend time with those 10 people? Or are you going to spend time with those 90 people that did not even buy your book? I used to be one of those people, by the way. I used to go up to center of influence and say, oh my God, I love your book. I love everything about you. But today is not a good time for me to buy your book, but one day I will do it. But what I want you to do for me today is, can you partner up with me? And I used to wonder why they don't partner up with me, because it's all about relationships. Relationships are built by spending time with them. And the way you go closer to these people is, like I said, lose-win situation and break bread with them is another way to do it. And when you go to the events, like I said, you can sit in the back or you can sit with the leaders and figure out, is there a chance that I could spend time with not only the speaker, but their center of influence sitting in the VIP area? Is there a chance that I can connect with them, break bread with them, network with them? Because without the relationships, without the trust, no one really gives you money. Nobody wants to do business with you. It's just as simple as that. So when people say to me, what's your secret? I said, just go and make authentic relationships. You know, you're going to naturally be attracted to some person. You don't have to be attracted to 100 people in the room or 20 people, 1, 2 people, that's it, 3 people. By the time you leave, they should know your name and you should know who they are when you get home. And if somebody says, hey, it's Jackie, you're like, oh, I know who Jackie is. Not like, you know, who's Jackie again? I forgot, you know. You need to build those relationships when you go to the events. Very, very important to do that. So lose-win situation, buy the best tickets, and then third is buy their programs. Again, if you can afford it, buy their programs, join their masterminds, you know, whatever. Maybe they're selling you $500 program or $1,000 program, buy it. If you don't buy it, chances are very little that they're going to do business with you or do anything with you. It's just the way it is. Number 4 is to join elite real estate clubs. Now you're here in this training, for example, there's some people who have lots of money. In my club, Kevin Harrington is a member, Jack Canfield is a member, Brian Tracy is a member, Robert Allen is a member. Millionaires and multi-millionaires are members of my club, and they invest in Canada and United States. And I have members in the United States who also invest. They have access to money, connections. And at the next event, for example, on Saturday, upcoming Saturday, October 1st, in Toronto, I'm going to have millionaires and multimillionaires in the room, right? I'm going to have amazing people. So our goal is to make 100 millionaires. And one of the ways to do that is that you go out and build relationships with center of influence people with money. People with the money, center of influences, they don't have time to talk to people who are not yet successful because they get approached all the time. They get approached all the time. I remember I was in Michigan many years ago, and I was one of the sharks, let's say, and people were pitching their stuff to us to invest with them. And I remember talking about what do I need, you know, and this is the next level of obviously lesson today, and that is this: find out what they want, you know, to invest in. So I was on the stage talking about, you know, as an investor, what would it take for me to lend you the money? And then after I was done, I went to the washroom, and I was in, and I was conducting the act of urination, where somebody walked up right behind me, close to me, in the washroom, and said, "Hey, bud, can you give me $1 million?" So that's not what I'm talking about. You're not going to sneak in. You're not going to get money from people that are strangers. You're going to get money from people you like. If they like you, they trust you, and you have a good deal. Now, there are times when you have a good deal, strangers will give you money, that's for sure. But if you want to grow to massive levels, you want to become the next Uber, the next Apple, the next real estate success story, where you're building generational wealth, the relationships are very, very important. So the next level, the 5th thing that I said to you is find out what do they like to invest in, and then only give them what they want to invest in, the way they want you to show them. So if I say to you, I need this kind of information package, I need the photos, description, I need sold comps, I need rental comps, I need a pro forma, and I want pro formas to add, I want you to add vacancy allowance, I want you to add these expenses. You don't say, well, this is how I do it. No, you say that I'll do it your way, and you send it in, and the chances of you making lots of money is a lot higher. So attend virtual and in-person events on a consistent basis for the purpose of learning and networking, and more importantly, building deep relationships. The difference between networking and deep relationship is that networking is you're just talking, you're getting to know somebody. Deep relationship is when you go home, you're like, man, I had so much fun with that person. And you maybe later on, you go to coffee with them or have lunch with them or call them up, Zoom calls or whatever. You actually want to build relationship with them. Because if you go to an event and there's 100 people, you're not going to become friends with 100 people. At least I know I'm not that type of guy. There are some people who would, but most likely you're going to become friends with maybe 2 people, 1 person, 5 people, and that's it. You know, and deep relationships, you know, is very, very, very important. And then learn from whom? Learn from people who have done it. You know, I keep talking about learning, and people think, oh, I'm talking about schools, I'm talking about this and that. No, I'm talking about learning for people who have done it. So if there's a mountain, and on the top of the mountain is your $1 million, and you want to climb that mountain, and you've never gone up to that mountain, put $10 million on the mountain, $100 million, doesn't matter. Point is, you want to go to climb that mountain. You can do it, try to do it yourself. You can, you know, and you can hurt yourself, you never make it or whatever. But what about this? What about you find somebody who's been there 100 times, up and down? Take them with, say, hey, could you take me? And then people are going to say, well, what if he charges me money? What if it costs me money? They never cost money. They never cost money. It's an investment. It's a shortcut. It's safer. It's better. And that is how you do it. Now, last thing I tell you is that how did I actually build relationships with my mentors, people who I used to read their books? How did I start sharing stages and written books with some of these people? Did business with Tony Robbins and Grant Cardone's of the world. How did I do that, Jack? How did I do this? And simple. I just basically said, what would it take for me to spend some time with them, with a small group of people, or one-on-one, or whatever it is. In the beginning, it was a small group of people, because people think a mentor or a coach is somebody who's going to give them this incredible knowledge that they've never heard. Yes, sometimes they'll give you some insight, they'll give you inspiration, they'll give you some ideas. Yes, they're all important. But a great mentor not only inspires, but then opens the doors for you. That is why relationships are very important. So when I went to, let's say I went to one of the mentors, and there were like 10 people in the room or 20 people in the room, and we spent a whole day with this center of influence. And what happens is, during these mastermind, center influences goes to one by one and says, hey, what are you working out? What do you need? What's your goal? And then we work on those goals. And at the end, the center influence, in some way, in form and shape, says, what help do you need? What can I do for you? And then that's when I said, well, I need more money. I need more capital. Do you know somebody who can do this for me? And I remember one of them, I was trying to get hold of this person, and for a year or so, and they just would not respond to me because they didn't know me, right? And then when I hired this center of influence as a mentor, this center of influence knew the other center of influence that I was trying to get hold of, and they wouldn't respond. And he goes, oh, that's easy. I have his cell number. He calls this center of influence and says, hey, yeah, how you doing? Oh, by the way, I have my friend Sunil here, and you two should connect. And the guy's like, oh, yeah, sure. I'm like, oh my God, I was trying to get this guy for a year, and all it took is one phone call. And that was worth the whole thing for me. So if you are thinking of raising money, you're thinking of buying properties, no money down, you're thinking of assigning deals, then you need to connect with people who have access to money. You need to connect with people who have access to money, and then they have access to money. And this is very, very important. I don't mean made up fake relationships. I mean, genuinely, you are interested in them. You like them. Let's say you meet somebody and they're successful and you don't like them. Then don't do business with them. Don't go to them. Only go to the people that you look up to. They inspired you. Like, man, I want to be like him. Like, this is the important part. I like his lifestyle. I like what he has achieved. I want him to show me. I want to get to know this person more and more. So short and sweet, but it's very, very important that you create a lose-win situation. You connect with center of influences, because one center of influence can absolutely change your life. And if you don't have lots of money, volunteer, show up at their events, buy their cheap tickets. It doesn't matter, but show up on a consistent basis. So those of you, thank you very much for some of the chats I see now. Hello, Mike. Jay, good, thank you. Mike Chodri, yes. Thank you, both of you, for your comments. And by the way, if you are here, and I see there's some people here that, if you're here, I have a great opportunity for you. I'm going to actually see if I can put this in there. All right, I just put a link in the chat box. I'm having one of the biggest events where people from all over the world are coming. They're coming in person from all over the world in Toronto, and they're coming virtually from all over the world. It's called Wealth Mastery. And because of Linda, once again, I'm giving you guys not the general ticket, but I'm giving you virtual VIP ticket to attend my Wealth Mastery with Robin Sharma, Kevin Harrington of Shark Tank, Michael Tracy, myself, Sinead Desai, and these are top leaders. We're going to talk about business, cash flow, how to raise money, real estate, where the real estate market's going for Canada, United States, and globally. If you want to grow and have a business that's going to thrive, you want connections, you want access, virtually, even if you can come virtually, it's okay to have that energy and meet people virtually, because as VIPs, you are going to be able to network through chat as well. There are regular tickets. They won't be able to chat. They won't get the recording of the event, and they won't be able to come to the next day. As a VIPs, you'll be able to come on Saturday and Sunday, both days, if you want to come. So there's the link. And I put it, somebody just asked, can we have a chat? I just put in the chat, it says host and panelist. Oh, that's why. I didn't put it for everyone. Let's see. Let me see.
I can go
Okay,
ahead
guys.
and do that. Oh, great. Thank you, Sunil.
You're welcome. Ladies and gentlemen, go there right now and you get a VIP virtual ticket because of Linda from Realty411. I've known her for many, many years now, and she is committed to adding massive value to you guys. And I've decided to come and speak to you, to inspire you, to help you grow to massive level. Our goal is to make 100 millionaires. We've made many millionaires, multi-millionaires, and we're going to continue doing that. And if you want to get that, that's one thing. And then all of you will have the digital copy of this book if you want. And one of you is going to win this big confidential package on raising money. And by the way, when you win it, you will have to pay for the shipping. I will send this to you for free, but you'll pay for the shipping, or you come to see us at the next event and you can pick it up for free, whatever you like. But there will be one winner for that. Last but not least, Linda, I know I didn't say that to you, but I will even allow one person. I know this is in Toronto. So if one person that wants to fly to Toronto and come to this event for next Saturday and Sunday, I'll give them a VIP gold in-person ticket, which means your breakfasts are going to be paid for, your breaks are going to be paid for, your lunches are going to be paid for. It's at the Western Harbor 5-star hotel. You're going to be treated like royalty at that. And you're going to meet millionaires and some of the multi-millionaires. You're going to meet some of my successful students, people that you can possibly connect with. So if you want to win that, I want you to send an email to admin@privateinvestmentclub.com. And just in the subject line, say, I want to win in-person ticket. And the other one, you already will get the direct access to. Please do not share this link with everybody or anybody. It's for you guys to get the VIP tickets, because we are selling the virtual VIP tickets all over the world. So I think I'm very close to your lunchtime. If yes, thank you very much for the link and all that you guys are doing. As I finish off, I'm just going to say to you, there are some exciting times or there are some dangerous times. It's your perspective. Which side are you on? The dangerous side, meaning you will lose everything that you have. Your properties will go down in value, and people will just lose everything. On this side, it's going to be marvelous because people who lose money from here are just simply going to transfer the money over to these small group of people who will become millionaires and multimillionaires. And this is going to be, in my view, one of the best times of our lifetime to make huge amounts of money. Whether you have money right now, whether you want to buy no money on, maybe whether you have never done it, maybe you're starting out, maybe you're already a veteran investor. It is the best, our best time to make huge amounts of money is coming. I truly hope to look forward to seeing you guys one day, virtually, face to face, however, and I wish you all the best. Thank you for having me, Linda. Thank you very much. I appreciate you all.
Thank you again so much for your time, Sunil, for your knowledge. We really appreciate it very much.
You're
So
welcome.
definitely take action, folks, and connect with Sunil. We put a few links in the chat, including the link to his website, so you can learn more information about Private Investment Club.
And get this book, guys. If nothing
Yes.
else, get your free book, and I will gift you a physical copy. You just pay for the shipping, or digital copy completely free. And I hope to see you guys Saturday and Sunday virtually, and one person, a VIP guest in person. Thank you guys again.
Thank you, Sunil. We really appreciate that very much.
Welcome. Bye-bye.
Thank you. Take action, everyone. He offered a great book with just the shipping fee. So definitely take action and get that book. You're going to learn so much. With this in mind, we're going to go ahead and take a break. Jason, do you want to add anything before we go to break? Okay, so we're going to go ahead and go to break, folks. We'll see you back at 1 o'clock. And thank you so much for joining us. Don't go anywhere. Take a quick break. And we will see you back at 1 p.m. for the rest of this event. Thank you again.
Hey there. Good. Okay.
Hello, everyone. Hello, ADL. How are you?
Yeah.
Hi, Linda. Very nice to see you.
Thank you. It's such a pleasure to see you. Thank you, Jason, for helping out with the technical part of this event. We really appreciate you. Jason is at the background, making sure everything goes well, making sure the event goes smoothly. So I really appreciate that, Jason. ADL, guess what? This is the first Realty411 virtual event that we live stream on Facebook. So yeah, so we're also live streaming on Facebook. I have 3 different Facebook group accounts and many Facebook groups. So it's exciting to be able to share this with more people on Facebook as well.
Absolutely.
So we're so excited that you're here. And I know that your specialty is investing across the country for cash flow, long-term appreciation. I love your message, ADL, because it's solid, secure real estate investing, which is what I believe in. You know, I'm a long-term growth type of investor, and that's what you preach. And I love the properties that you also make available to our investors, as well as the different hot markets around the country that you spotlight and make available for investors to take action and purchase. So go ahead and take it away, ADL. We're excited to have you.
Linda, thank you very much. It's really a pleasure to be here with everyone. And I would very much like to share with you what I believe could be something that's a life-changing way of of investing. Also happens to be very simple, and also as an added bonus, usually is one of the more conservative investors, so safe, life change. So my name is Adiel Gorel. I'm the CEO of a company by the name of ICG, stands for International Capital Group. We've been doing this, or I should say that I've been doing it for 39 years. And no, I didn't start when I was 1 year old. 39 years, next year, 40 years. And I think I told the story of how I got started quite a few times in the past. But for the people who are brand new on this line who have never heard this story, I'll tell it very briefly. My background is in Silicon Valley, high tech. I taught at the university there, electrical engineering and computer science, very tech. Then I got my first real job in Silicon Valley at Hewlett-Packard Labs. I was living in Palo Alto. Hewlett-Packard Lab and Stanford are maybe 2 miles apart, less, very near. And I got much more, Hewlett-Packard paid me much more than Stanford did. So I thought I was being extremely well paid. And I thought, wow, this will really secure my future in 20 or 30 years working here. But when I talked to colleagues who have been working there for 20 or 30 years, I saw nothing was secure in their future financially. They just had a 401k in their own home with a mortgage. That's it. So I said, no, I can't be like this. I'm going to start investing in rental homes. And back there in the 1980s, there was a saying, only invest within 30-minute drive of where you live. I followed it. I was living in Palo Alto. I bought in Sunnyvale, in San Jose. Very quickly, I realized I couldn't build an empire investing in Silicon Valley, because even in the 1980s, even though all the numbers were much lower, the ratio between rent and price in Silicon Valley was not friendly at all. It's still not friendly. It wasn't friendly back then. So I said, I'm going to have to break this rule. And I went to a smaller city called Las Vegas, and it took me some time. I needed to find a property management firm that I felt comfortable with because I was living in California. And then a broker who would work with me. And I started buying at quite a good clip. After I bought 22 homes, strangely, many of my Silicon Valley friends said, can you help us do the same? I said, you don't need my help, just go and do it. They said, no, you're already there. You've bought more than 20 homes. You have your manager. So I led a group of people, and over a few years, we bought about 250 homes in Vegas, not as a group. She bought 6 homes, he bought 4 homes, I bought 2 more. But we made the almost trivial discovery that even the engineer who was very scared and bought just 1 little home as a test enjoyed the clout, the power of 250 homes. Because if he wasn't happy, or she, as the case might be, the managers knew they would call me. And now I wouldn't be happy. And every other property manager in Vegas was calling me all the time. Come to us, we are better, we are cheaper. So the manager knew if even one investor wouldn't be happy, they stand to lose the entire management of 250 homes, plus the many, many dozens, if not hundreds of homes that we might buy in the future. Now we would jump into the present, well over 35 years with that. I started 39 years ago, and we're doing the same thing, except, well, over the past 35 plus years, my investors bought well over 10,000 properties in about 30 markets, including out of the 10,000 plus, 2,000 plus people who live across the ocean, foreigners, who are not expected to fly over to fix the leaky faucet. So there are many reasons, and the rationale for doing this is very strong. And this is what I want to share with you. And I sincerely hope that it will be a life changer. Also, for newer real estate investors, this may be a relief, because we hear about such complicated schemes of this and fixing and buying. This is going to be simple, but this simplicity has enormous power. One of the things that blew my mind when I started investing decades ago was I found out that they're giving a mortgage here called, you all know it very well, 30 years fixed. My mind was blown. You can hear I speak with an accent. I came from a place where they don't have that. They don't even have what we call adjustable loans, which still have a lifetime cap and a yearly. No. The payments and the balance of the loans in the country that I came from constantly track inflation, constantly track inflation, constantly track inflation. So it's not uncommon. You have a mortgage of $1 million, I'm just making numbers up, and your payments are $4,000 a month, depending on the interest rates. And then you pay like clockwork for a decade. And after the decade, all of a sudden, your monthly payment is $7,000 and your loan balance is $2 million because inflation was high, it tracked inflation. So I discovered that, at least to the best of my knowledge, the 30-year fixed rate loan is only given in one country in the world. And that country is called the United States of America. It blew my mind. Even today, when I talk in other countries, let's say in Europe, the Europeans refuse to believe that what I'm telling them about the mortgages we can get here, namely 30 years fixed, is true. They say, no, it cannot be true. You have inflation in the US, always, not just high like now, always lower, higher, there's always inflation. 30 years ago, you bought a postage stamp for 4 cents. Now it's 56 cents. 30 years ago, you went to the movies in New York City for $2. Now it's 16 bucks. If you go to Whole Foods today and you buy a beautiful organic avocado for $2.25, you know, and we know, and everybody kind of knows that in 10 years, the avocado is probably going to be $4. Inflation. How could anybody lend you money for 30 years where neither the monthly payment, which will never change, even though in 16 years, maybe it's just enough to buy dinner for 2, nor the loan balance, which goes down with the principal payments of amortization? How could it be? Everything in the US economy rises with inflation. You need more dollars to buy. The avocado, now it's 2.25, in 10 years, maybe it's 4, everything, except your loan payment, principal and interest, and your loan balance. If that were true, the Europeans say, it would be the biggest financial gift in the world. And I wholeheartedly agree. The only person I was in touch with in the United States that completely gets it, because most people in the United States take it like such a given. Oh, 30 years, of course, like the sky is blue. Oh, sure, we know that. The person is named Warren Buffett. He is keenly aware of it, even though he's a stock and acquisitions guy. He was interested in buying lots of homes and putting 30-year fixed rate loans on them until Fannie Mae told him they will only give him 10. But there's actually an article in Entrepreneur magazine about my interaction with him about the 30-year fixed rate loan. And Buffett gives us one of his core advice. I think there was an article that said 4 things you need to do to get wealthy. One of them is get a 30-year fixed rate loan, because inflation becomes your best friend. Inflation erodes the loan all the time, day and night. When inflation is higher, like now, it's an even better friend. So what does it look like? Well, I like to tell one of the thousands of stories, and I'll tell you one. A guy working, I'll tell a different story this time. I think last time I talked about, the Silicon Valley guy. Here's a doctor who I know, and he's now 62. He's going to be 63 the end of this month. He started investing in his 40s. He bought just one home. He's a neonatal specialist. Bought just one home as a test. Liked it. He saw that it didn't really take up his time. The managers did the rentals and all of that. Bought another one. He was putting the minimum down payment that he could as an investor. Back when he was in his 40s, I believe it was 10% down with PMI. Today, it's actually 15% down with PMI. It doesn't matter. He ended up buying 19 homes. And then when he turned 58, he looked at his 19 homes, and they all had 16 years left on the 30-year term, not even halfway. But he saw that the balance of his mortgages, which started out at 90% loan to value, was after 14 years in this example about a quarter of the value. That's what inflation does to the fixed rate loans. It decimates them. So he said, okay, I'm selling 4 of my 19 homes, paying my capital gains like a good boy, no 1031 exchanges for me, took the money that was left after paying the capital gains and the depreciation we capture, and paid off the remaining little tiny 15 loans. And now he said, I know I'm 58. I know I'm a very youthful 58. I'm a successful doctor, but frankly, with 15 free and clear, nice homes, I don't have to work anymore. And he retired at 58. Today he's going to be 63, the end of this month. He's a friend, actually. He bothers me all the time. Let's go here. Let's go. I didn't retire. I chose not to. I love what I do. I love speaking here and sharing with you because I feel like it makes a difference. But I have thousands of stories like the one he told, including people who just bought 1 home or 2 homes. And from that, 15 years down the road, 14, 13, 17, send their kid to Harvard for 4 years. And so this is very powerful. So because in the United States, and to the best of my knowledge, only in the United States, they can give us the unbelievable gift called 30 years fixed. And now we have a better appreciation, no pun intended, of what that means. Everything becomes very clear. Let's just buy good properties in good locations. Doesn't have to be great properties in great. You don't want to buy in, in Palo Alto. No, let's go to good, solid places, buy good, solid homes, preferably new. I'll talk about that in a second. Put a down payment and get the 30-year fixed rate loan. Let a local property management firm rent out the homes for you and deal with them and handle them for you, because you are likely a busy person. And then proceed to do the hardest action for a human being to do. Nothing, just nothing. This is not going to make you rich in a year, but it could change your life in 10, 12, 14 years, depending on what the future brings. And it's changed the lives of many thousands of people, including my own. I'm choosing to be here because I love what I do, but very powerful stuff. And as a bonus, you don't have to flip and fix the kitchen and you do this. No, you're a busy person. You buy beautiful brand new homes and you do nothing. Simple. But the heart, the core of what you're doing is you're placing the 30-year fixed rate loan, and then you sit back and let inflation do its job. So there's a cliche in the world of real estate that says what you owe today, you own tomorrow. So true, so true. I mean, I used to have a lot of fun just looking at my mortgage balances go down all the time. The houses, on average, keep up with inflation. It doesn't matter that they went up and now they're down. And over time, everything keeps up with inflation. The cost of the avocado, the cost of the tomato, the cost of rent, the cost of houses, the cost of shoes. The only thing that doesn't keep up is inflation, is your mortgage, payment and balance. So inflation makes them look smaller, punier, and more negligible as the years go by, hence building your wealth. It's hard to think of something simpler. So people say, well, what kind of properties should we buy? Since the heart and soul of this is getting 30-year fixed rate loans, 30-year fixed rate loans are only given on 1 to 4 residential units. A single family home, maybe a condo too, duplex, triplex, or fourplex. I actually prefer the single family home. When you go to a city in the United States, you go to the good neighborhoods, all you see are single family homes. You want to see duplexes and fourplexes, you need to go to another part of town. Many duplexes, many fourplexes. It looks like this, it appreciates like this. harder to manage. The tenants are on top of each other. The only exception is maybe duplexes in a good part of town. And some of the markets we are in, our teams have so much muscle because today we have markets where over the last couple of decades, we bought 2,000 homes. So we carry a lot of clout, and they convinced builders to build high quality duplexes in a good area. But by and large, the single family home is the best. It will do the trick. It's the American dream. It's the most liquid real estate. When you come to sell it, you don't need to sell it to an investor. All the families in that place are your potential buyers. And in the markets where it's still affordable, which there are markets where it's relatively affordable, that's still the American dream, living in it, especially after COVID, because during COVID, we were locked down. People started appreciating, once again, no pun intended, having a backyard in case there would be another virus. Who knows? Could be another one. And then people started seeing that a lot of people can work from home. So single family home with a yard and a home office became the darling of the US economy during the pandemic. And for me, it was my darling for decades and decades. So I'll talk about the pandemic. I'll talk about the interest rates. I'll talk about all the stuff that's going on now. But first, let me talk about, okay, so we buy single family homes, by and large. Where? So I've been a student of the demographics in the United States for 4 decades, pretty much, more actually. Before I started, I was already studying it. And to me, the demographic wave grows in a favorable manner into the Sun Belt states. So to me, the Sun Belt states are the sort of, not the very low, but not the northern part of this country. So I think states like Nevada, Arizona, Texas, Oklahoma, Louisiana, Alabama, Mississippi, Georgia, Florida, states like these, by and large, and New Mexico or whatever. So that's criteria number 1 for me. Criteria number 2 is buying in a large metropolitan area. Very simply for job and industry, job diversity, more jobs, many jobs. I also like the suburbs, as I just explained. Families, kids go to school, it's very stable. And finally, it took me a few years, but I now very much like to buy for me and recommend to you buying brand new homes. By the way, I wrote a series of articles, some of them for Linda in the Realty411 magazine, and I'll be happy to share them with you if you'd like. All you need to do is send us an email at info, like information, info@icgre.com. And I'll send you those articles. I'll send you the article about me and Buffett, and I'll send you the link to the television show I was invited to do for PBS, for public television, about this. And of course, very high, production. It's ran hundreds of times throughout the country. So I can send you all of that. Just send us an email, info@icgre.com. So new homes. I began my career investing as a typical cash flow cowboy. I was only looking at the sheets and I wanted the better cash flow. So I bought homes in areas that were so-so. And I bought older homes and I fixed them up, the drill. Then I discovered as the years went by, I actually was doing better, not to mention getting less gray hairs, if I bought brand new, beautiful stuff under warranty by the builder. The air conditioning is under warranty by the company that makes it. The roof is under warranty, all of that stuff, brand new, tenants love, much less repair for years to come, getting started with a newer home, only benefits. Some people think, oh, but that's going to cost me so much more. No, for comparable quality and location, not necessarily. In fact, dealing with builders, maybe with the exception of the pandemic, which I'll talk about in a minute, is actually a door to get discounts. Because when we bring in all of our investors, the builders know, especially now when builders are not getting as much demand, they know to appreciate what we do. We're bringing them all of our wonderful investors from Silicon Valley and doctors and lawyers, nurses and teachers, but usually very well qualified. Even the foreigners are well qualified. So the builders say, you know what, okay, for your investors, we're going to throw in the covered patio. We're going to throw in the appliance, but whatever it is that they do, and we'll give a discount or pay the closing costs, things like that. So brand new homes, suburbs, large metropolitan areas in the Sunbelt states, single family home, and then you go. So, I mean, I actually discovered decades ago that I enjoyed so much, I quit my high-tech life. That's kind of weird because I invested so much in my education, but it was more fun. More than 30 years, helping my Silicon Valley friends when we were buying in Vegas back in the 1980s. So basically, we will connect you to our local teams, the broker team we work with, and some of these broker teams have sold us, me, and our investors thousands of homes. They really know us, we know them, we trust them, and then a local property management firm again that might be managing well over 1,000 homes for us. They really care to please us. Hence, they care very much to please you. They don't want you to call us and then we say, what's going on with Mary's home? I don't know. So, I mean, I'm not saying it solves all the problem in the universe, but it's very helpful. So we will hold your hand. I myself, when I decided not to retire, I had to find balance in my life. If I'm not retired, I don't just want to work. So I dedicate half my time to meetings with you one-on-one. You want to talk to me? Just send us an email, info@icgre.com. They will schedule a meeting with me. I have a lot of my meetings by phone, walking in my backyards in the sun, looking at the bay, not very hard work, and talking about something that I'm passionate about. Can you tell that I'm passionate about it? I'm very passionate about it. So that's half my time. The other is I even did a PBS show on health and wellness. And I now have a podcast on health and wellness. I interview great people from all over the world, experts on many facets of how we can be healthier, stronger, eat better, move better. And my job when I interview them is to simplify the message into what can we do tomorrow, right now, at no cost or low cost. So if you want to find it, it's called The Adiel Gorel Show. You can find it everywhere. Apple Podcast, YouTube, Spotify, whatever you want. And then to finish the balance that I chose for my life, I create music in my home studio and produce it with two professional musicians out of Los Angeles. So I write the lyrics, I play the lead guitar, and I sing it. Once again, just plug in my name, it's everywhere. Everywhere, Spotify, YouTube. Yeah. So, but I will meet with you because I enjoy it. I love it. I feel like I'm helping you change your life. So that is the balance. But we will help you. So let's say I just talk to you. I see what your goals are. I don't have to do much. I could be the laziest person in the world. I just connect you via an email to our local team in a market that we talked about. I'll discuss markets in a second in more detail, and then they work with you just as if they were the realtor next door to where you live. Maybe you go and travel and see it, which I love when people do. Maybe you're too busy for that, whatever it is. You choose a home, you buy a home, we'll hold your hand, and now the local property manager leases it for you. For those of you that have never bought an investment home, especially out of state, the most important one you'll ever buy is the first one. Because there are all the questions and question marks. What? Buying out of state, what am I going to do? What is it going to rent? What did you do? Okay, so you buy the first home, the manager rents it for you. Now it's rented and boring. You've broken the ice. Buying home number two, just a repetition of the same process. Buying home number four, downright boring already. I have people who bought 60 and 70. Yes, Fannie Mae will only give you 10 Fannie Mae loans, including the one on your residence. If you're a married couple and both of you can separately qualify, Fannie Mae will let you have 10 each. and you can take the title in both names. But beyond Fannie Mae, there are lenders who make non-QM, non-qualified mortgages, meaning not under the Fannie Mae umbrella. That's why I have investors who bought 70 homes and 60 homes, but many people see a beautiful change in their life. Again, not tomorrow, but in a decade and a half, even with 1 or 2 or 3 or 4. It's not a race, it's not a rush, very stable stuff. So I'll connect you. And then if you have questions, issues, complaints, I and my staff are here for you. So people ask me always, well, what do you charge for all of that? Well, we used to charge our investors, but then I noticed over the years, I am from Silicon Valley. I have an engineer's mind. And so people like us tend to want to complicate things. I said, you know what? I want to simplify. About 20 years ago, I said, okay, let's not charge our investors anything. We don't charge you anything. So what's the business model? Okay, well, we are a licensed broker. We split the commissions with the local teams, and that's it. It's not a whole lot. These are not expensive homes, but it's quite enough, and it's simple. So we'll support you once every 3 months for more than 30 years now. Once every quarter, we have an expo. And it used to be, until COVID, it used to be live near the San Francisco airport, beautiful venue, hundreds of people. I fly in the market teams to talk to you, to talk to us, show us their markets, give a PowerPoint, meet you, press the flesh. I take hundreds of questions and I bring experts, lawyers, 1031 exchange people, insurance people, beautiful days, a whole day on a Saturday. Since COVID, well, our last event live just kind of sneaked before they locked us down on March 7th, 2020. And from then on, it's been by Zoom. We shortened it for 4 hours. Our last event was just recently, 14 days ago, Saturday, September 10th. And so the next one will be on a Saturday, December 3rd. You're all invited, doesn't cost anything. And you can register on our website for free. You, your friends, your wife, your husband, whatever, under icgre.com under events, you know. And so I think you can get a lot of benefit from that. So I'll connect you to those teams. They will work with you to buy your first home or your second or your nth home. Now let's talk about which markets work right now and what's going on with the economy in general. So as we know, even in 2019, before COVID started, many of the beautiful big Sun Belt states markets where we bought thousands of homes already were a little too expensive relative to the rent. So even in 2019, Vegas was iffy. Phoenix is our biggest market. We bought more than 3,000 homes over 21 years. Phoenix was iffy, Dallas not sure, Austin not sure, Houston, but then COVID came. And as you know very well, people started to be able to work out of their home. Many tenants didn't want to live in apartment complexes and share the same elevator with the virus being spewed out by people. People wanted a home with a yard, like we said. So the rental market became stronger. The demand for buying became strong. Interest rates, because of COVID, went down to the incredibly extreme low point of, I believe it came down to close to 2.7%, which is without any proportion to history. It went down to this incredible trough. I think it was something like 2.7% for a homeowner. Even our investors usually get a little higher rate. Went down to 3.5, even 3.25 with a point. Unbelievable stuff. So of course, demand skyrocketed. Supply really suffered because there were supply chain issues, labor issues. So all over the country, pretty much in most markets, not all, but most, there was huge demand, tiny supply, prices skyrocketed. We had to put people on waiting lists in some of the markets. Even some of the builders said, you know what, we don't even want to work with investors, just with homeowners. because they could call the shots. Then inflation reared its ugly head. And as you know, the Fed embarked on a series of interest rate increases, culminating in the last one, which there may be more, that was 0.75%. So the mortgage rates, which also try to guess the future a little bit, are now higher. They are like something like 6.29 this morning, or for homeowners. So from 2.75 or 2.7 to 6.29, that's a doubling. So somebody who's not familiar with history will say interest rates doubled. Doubled. This is insane. I'm never buying real estate anymore. The rates are so high. 6.3? Are you kidding me? That's okay. By the way, investor rates are always a little higher than homeowners. So investor rates are now touching the 7 mark. It seems like the end of the world. Well, for somebody who's been doing it for nearly 40 years, and I have friends who've been doing it for much longer, we know that 6%, 6.5%, 7%, 7.5% mortgage rates historically are actually quite low. Most of my career, 39 years, if you told most of my career, not all of my career, most, if you told me that you're giving me a loan at 7.5% fixed for 30 years, I'll be dancing for joy. The story that I told you about the doctor who retired, when he was buying it, he was in his 40s. I think it was the beginning of the 2000s. Most of his loans were between 7.75 and 8.25. Succeeded very well. So that's one thing that people don't get. The rates are still very low. Not that it matters. The fact that it's fixed rate and there's inflation, it will always work. In fact, you want to hear a smart aleck kind of point? All right, a year or something ago, the rates for a homeowner, let's call them 2.75 for the sake of 2.75. Inflation was 2.5. All right. Today they are 6.3 nearly. Inflation is 8. Which one is the rate higher? You could argue, although the interest rates are lower now when you count inflation. Never mind that. When I started investing in the 1980s, those first couple of dozen homes that I bought in Vegas, the interest rates for mortgages were 14%. 14, that is 14. Because I was a young guy and my scarcest resource was cash, I wanted to use my cash judiciously, and build as much of an empire as I could using 30-year fixed rate loans, which, by the way, back then were not limited to only 10. Hallelujah. I don't know why they're doing it now. I put the minimum down. You don't have to be a great mathematician to see every home I bought with a minimum down payment and a 14% loan started out with a negative cash flow. Negative. What would fat uncle, thin uncle say? They would be rolling in their graves, whether it's a narrow grave or a wide grave. No problem. I had a very clear picture in my head. Well, first, I was a young guy working at Hewlett-Packard Labs, getting paid well, single. My expenses were close to zero, really, very, very little. I could afford those negatives easily. But more importantly, I had a clear picture in my head. Today, it's negative. Tomorrow, which could be 2 years down the road, a year, 3, I don't know exactly. Tomorrow, it'll be break even. Why? The monthly payment, principal and interest never changes. It's fixed. But the rents keep up on average with the cost of living in the marketplace. So it'll become break even. And then the next day, which could be another 2 or 3 years, whatever, the future, it'll become positive. And then more positive and more as the years go by. That's with a 14% loan. That's exactly what happened. Those few dozen homes that I began and I bought at 14% interest would have already been enough to retire me well, make me strong, and change my life. Not to mention that when the rates went down on mortgages from 14 to 12, I refinanced down to 12. Sounds funny when you say it, down to 12. Yeah, I did. And then they became much more positive. And then came the most special day, the happiest day. The media was all over it. Single digit rates, single digit. Can you believe it? We all ran out to refinance our mortgages to 9.95. What a happy day that was. Of course, they shot up on the positive immediately. Today, investor rates are around, let's call them 7. People say, oh, woe is me. It's the same logic. Maybe if you put a minimal down payment, it will not start with a positive. Start with a break even or a slight negative. What do you do for a living? You work in Silicon Valley? You're $100, who cares? I don't look at these homes as having been meant to feed you today. Today you work, you have your business, your spouse might work. That is what you eat from today. You wait for 12 or 14 years, then the houses will feed you so well, you could probably retire and send your kids to college. So right now, the cash flow comes from your job. And if the homes have positive 200 or negative 200, does it really matter? For most people, it doesn't. Now, suppose you bought a single family home and you got it rented, and now you're just doing nothing, it's boring, and the mortgage is at 7%. Well, as the years go by, rents are going up all over the country, not in all places, but 90% of markets, rents are going up. Part of the reason is the media is always looking for headlines. They want clicks, they want followers, so they need a sexy headline. With all due respect, the war in the Ukraine is old news. With all due respect, COVID is very old news. Well, what's the sexy news now? The housing market. It's falling, it's disappearing, it's recession, it's this. Every day, everybody compete with each other to belittle and put down the housing market. None of the experts dare or think about speaking about the elephant in the room. They give you a 30-year fixed rate loan in this crazy country and it'll change your life. Nobody talks about it. So people are so scared. Many homeowners, many would-be homeowners said, honey, we're not buying a home. Look at what they're writing in the media. The rates are so high. The rates are so high. Okay, fine. What do you do when you don't buy? You rent. So the demand for rental is huge in many markets. We're enjoying it. Very nice. So you can say, I'm buying a home, putting a down payment, maybe 20%, let's just say. At 7%, maybe it won't be quite a positive, maybe slightly negative, maybe break it, who cares? In a couple of years, it's likely to be break even and positive, then more positive, more, just like I said, with the 14%, except with 7. That's a lot better. And then what if the rates in the future, sometime, go down back to 5, refinance to 5, make it even more positive? What if they go back to the happy land of 3% or 4? Refinance, who cares? Just get it going and let inflation, which is high right now, start being your best friend, day in and day out, eroding your loan. You'll be the most sophisticated investor, even though you may be surrounded by people who complicate real estate investor by saying, and then I bought a chicken coop and I 1031 it in a triplex and then I fixed everything. You're likely to do a lot better by doing nothing, just letting inflation do the job. And you have nice new homes that are sitting there. I've seen it over decades. So the rentals are getting higher. The interest rates, while they seem so high, are still very low historically. Not very low, but quite low. I mean, I'm telling you, I remember even from not too long ago, the beginning of the 2000s, where rates went down from 9 to 8.5 and 8.25, and rates like this. So all I'm saying is, it doesn't matter what they say. They always are looking for a headline. Buy a single family home, brand new, as I said. Get a loan, a 30-year fixed rate loan. Wait out until it's boring, buy another one. Rates go down, you refinance. Rates don't, you stay. Change your life, no matter what. As I said, I've seen changes in people's life at rates of 14 and 12 and 11. Very simple stuff. Now, which markets actually work now? It's a double whammy. During COVID, the prices went up like crazy. And the rates went down. Now the rates went up much, and the prices were already very high. But because the demand is lesser now, because of the media scaring and the objective reason that the rates are higher, and the supply is actually higher now, because while during the pandemic, many builders suffered supply chain problems and issues, that they're still building as fast as they could to meet the demand. So now they have a lot of inventory. So for us investors, instead of having to stand in line and wait, now we can get good inventory to buy. And lo and behold, prices are softening up. I've seen in some of the markets, prices went down 5%, even 10%. I don't complain about stuff like this. Will they go down more? Maybe. Who cares? I'm a long-term investor. Let inflation start eroding my mortgage first. I'm keeping it for such a long time. There will be at least 2 or 3 cycles. And by the way, somebody mentioned at the beginning of my talk, they mentioned the word appreciation. I never know the future. I can't assume appreciation, but I don't even need appreciation. Let's go back to the avocado. So we go to Whole Foods today and we buy a nice, beautiful organic avocado, and it's $2.25. And I said, let's say in 10 years, the same avocado costs at Whole Foods $4, quite feasible, right? Are we going to say there was an appreciation in the avocado sector? No, we're not. It's just inflation. Same thing. I don't need appreciation. The house prices long-term will go up just based on inflation. If overall, with rolling inflation, not as high as now necessarily, makes everything require twice as many dollars, it will get to the house prices and they will cost twice as much. They may go up and down in the middle, but we don't care. We are long-term investors. While the mortgages shrink, not only because of principal payments, but because they know they never change with inflation. If there is an intrinsic appreciation as well, that's even better. We don't even need it. So very simple stuff. Let's see. Yeah, new homes, best friend. So people are kindly agreeing with me. I'm looking to see if there are any questions. But in any case, never a need to complicate. What I'm experiencing these days is somebody bought houses with us, let's say in Phoenix, where I said we bought 3,000 homes over 21 years. And they say, look, my house in Phoenix went up so much. And then now it's starting to soften up a little bit. My mortgage is already negligible. It's almost nothing. I can sell the home and do a tax-deferred 1031 exchange into 4 brand new homes in one of the markets that work. Which markets kind of work? I would say the Oklahoma City market is one of the most interesting in the country. It's so popular, by the way, that last year we had to stand in line. We had to be in line waiting for supply to catch up with demand. But now we can buy. So the Oklahoma City market is not far from Dallas on a US scale. The prices are much lower than Dallas. The rents are lower, but not by much. The property tax, 250% lower than in Dallas. The unemployment is something insane like 1.5%. I didn't even know that existed. Very powerful market. Our investors have bought about 2,000 homes there over 18 years. Very strong, we like it very much. What are the prices? Well, these days, to buy brand new homes in good locations in the suburbs, the metropolitan area, I love to buy in the suburbs, as I say, will run anyway, probably between as little as maybe 240 or 250 to as much as maybe 300 or something like that. And the rents are quite high. I mean, I don't know exactly off the top of my head, but it's possible that if you bought a home for 280, again, with low property taxes, maybe the rent will be 1,750 or 1,800, something like that. So that's one market. Another one is the Mobile, Alabama market. We've been buying there for 16 years. And there, the ratio between rent and price is maybe even slightly better. The prices are maybe between 270 and 310, again, very similar. The most expensive market we are still dealing with is a very popular market, and many people think it's going to have a lot of appreciation, but again, I don't bank on that, is the Raleigh-Durham Research Triangle in North Carolina. And there, the prices will run maybe 300 and up, maybe all the way to 360 or 70. They are softening up now, so that's good too. We also have some activity in Central Florida, but there you have to watch out a little bit because the builders in Florida are still very cocky from last year, and they want investors to put very high deposits, and some of you need to feel comfortable. So if you want to go there, you can talk to us. I invite you to come and join us at our next big expo on December the 3rd. You know, you could benefit, I think, from my book. I have a few, but the book called Remote Control Retirement Riches, which is also the name of the PBS show. It's on Amazon. It's a bestseller on Amazon, or at least it was. And you may want to get it. I think it'll be, not that I want to toot my own horn, but I think it'll be a good reference because it's decades of experience and all the details. And I'm always available to questions, to talk to you. Somebody here says, what's your contact information? So if you look at the chat, up maybe 5 comments away from you, there's a chat by Linda and her team that gives our email, info@icgre.com. Naturally, our website is ICGRE. You can register to our events. Even on the website, you can book to meet me. I love talking about it. I love guiding you. You know, I've already changed my life long ago. I'd love to change yours. So, I mean, if there's any other question, I would be happy to take it. If not, let me just talk about some other things. 1031 exchanges. So as I said, I see a lot of people now selling one home in Phoenix and doing a 1031 into 4 brand new homes in Oklahoma City. Not only that, they had a tiny mortgage already on the home in Phoenix. Now they buy 4 homes with bigger fixed rate mortgages going to work for them. Same thing from Austin, same thing. Oh, what should be the title on the email if you send? Just speak to Mr. Gorel, talk to Mr. Gorel, would like to meet. We also have a list, which I call our quick list. When there's plentiful supply of houses, the market send me houses once in a while, and I forward them to the quick list. We also send them invitation to our quarterly events and updates. If you want to join the list, you can put in the subject line, quick list, and be in touch with us that way. I want to talk about recessions for a second. So much of the media now, because they need a sexy headline, they need you to click, they need you to be there. Talk about recession. Well, the recession now will not be like 2008, 9, 10, because back then they were making loans to everything that moved. I think just at the very end, they were almost making in 2006 and 7 loans to cats. I don't know if they made loan to cats, but they almost did. So now it's the opposite. The Congress put in the Dodd-Frank rule. Most of the loans now are by very qualified borrowers. So we can't have a subprime crisis like we did then. But what do you do during recessions? I've been through a few of them. Even during the bad one. You know what happens during a recession? Very counterintuitively, the rentals are better and more stable. What? Yes. Let's pretend we are now in 2008 and you have a house in one of the markets and you have a family renting it from you. And they've been saving up for a down payment to buy their own dream home. Recession starts and the media goes to work. The sky is falling. Everybody's going to die. The recession, Lehman Brothers. Well, oh my God. So in that house, a conversation starts. And those conversations usually start with the word honey. We say, honey, we're planning to buy a house, but we are not going to buy it. There is a recession. Are you kidding? I could get fired. You can get fired. So they're not buying. So now they're not giving you notice that at the end of the lease, they're going to leave you and go to buy their own homes. So now multiply that scenario by millions, which happens. And now the rental market is actually more stable and better during recessions because of what I just said. By the way, when is the rental market usually the weakest? During a major boom, like during the boom of 2004, 5, 6, the media, once again, everybody's buying and making profit. All the tenants wanted to buy too. One exception, 2020, 2021. Even though prices were going up, rents were also going up because the demand was so high. Like I said, people didn't want to live in apartment complexes. Everybody wanted a single family home to rent or to buy. That's an exception. But during recessions, all you need to do is the hardest action for a human being to do. Nothing. Just sit there. The rentals are stable. You do nothing. The people who lost during the recession of 2008, 9 and everything are people who said, oh my God, the value went down so much. I'm underwater. I can't stand it. I'm giving my house to the bank. Here, take my home. Okay. If they kept it, today they would be doing a 1031 exchange from Phoenix into Fort Myers. So lots of stuff to share. Somebody here is saying, what do you think of short-term rentals? I would say, I would put it under the category of siren song. That means it's very enticing. Oh my God, I'm buying a place, I'm renting it like a hotel. I'm making tons of money. It's so amazing. Well, of course, you know, you're going to need it if it's not next door to you. You're going to need a management company that runs and operates like a hotel. They take management fees that could easily go to half of the whole thing. But anyway, still, you say, I'll make more money. It's great. The one thing that people forget with short-term rentals is when there is a recession at some point or an economic hardship time, the first thing that goes are vacations. And so many of the short-term rentals all of a sudden stay vacant. You still have to make your mortgage payment, your homeowners association payments, the property taxes, the insurance, everything. And I see a lot of people lose the short-term rentals when a recession comes. Whereas the long-term rentals, tenants, families, they need a place to stay. So my personal opinion, be patient, go for the long term, but it will change your future. Let's see if there's any other question. All right, but when you do a 1031 exchange, be careful not to just do it in a knee-jerk reaction. Sometimes I talk to people and we discover they have enough carryover net operating losses that they don't even need an exchange. So don't just necessarily jump and do an exchange without any need to. I'll always be happy to talk to you, whether you invest with us or not. I enjoy this. Let's see. Yep, I was one of the affected. Yeah, I was one of the affected too. I sold some homes. I got rid of some homes. Luckily, not many. But you know, every recession that went by, I learned something from. So the next one that comes, I'm going to do the best. I'm going to take the best course of action, which is, in my opinion, staying put, just doing nothing. The media can buzz, the media can sow, the media can be a buzzsaw. They can make all the noise that they want. It's okay. Pretty soon they'll have another subject to talk about. So with that, I want to thank you, Linda, and your amazing team for having me. I hope this has been useful. Feel free to be in touch with us for any questions or to talk to me. Thank you so much.
Thank you so much, ADL. You're such a wealth of knowledge and information, and we truly appreciate your time with us. We love hearing your insight. In addition to the people joining us here, we also are reaching out to people via Facebook Live for the very first time. We've never done it before, but we managed to be able to connect it. And it's exciting because I have a big Facebook following. I have 3 accounts and about 6 groups and 4 business accounts So it's all over.
Linda, you are a force of nature. And your general, demeanor and kindness, besides being a force of nature, makes this whole thing so enjoyable.
Thank you, ADL. Well, we really appreciate everything. So be sure to connect with him. Um, his information is on the chat, and he is ready to speak with you. So thank you again for everything, ADL, and we will talk with you shortly.
Thank you so much. Have a great weekend. Bye-bye.
You too. Bye-bye. Wonderful. Well, we're just having a great time today connecting with so many influential speakers. And it's a pleasure to be able to present our next speaker and educator, Jean. Hi, Jean. How are you?
Well, how are you doing?
I'm doing well. It was such a pleasure to initially connect with Jean in our South Florida event. We were in Fort Lauderdale, and my dear friend Michael Poggi, who I've known for so many years, connected us. And it was wonderful. He spoke in front of our group. Then he flew out to our Orange County event and spoke in front of additional readers. So we're really happy to have you here, G. Now, G is from Toolbox OS, and today he's going to speak on discovering how to 100x your real estate investing business with 3 secrets from Wall Street. So it's a great presentation. Take it away, G.
Thank you, Linda. I will take it away. You guys able to see this?
Yes.
Okay. Well, I always like to give the slides up front if you happen to be a person who likes to listen and then study slides later. So I have my slides just on this really short URL you can see, which is cofnd.com. So if you'd like to go there, you can follow along with the slides or whatever you'd like, or just take them afterwards. It's kind of a mi casa, su casa situation. Just a little bit of a background on me. I currently own about 100 companies. My first $1 million business was at 25. I built a bunch of software in my career. One of my softwares ended up 5 times net profit, which is kind of what really got me into entrepreneurship on a larger level was that event. I've had a couple exits. I bought and sold a business after my first business. And for about 10 years, I was mentored by private equity folks. And today I'm going to talk quite a bit about how private equity and Wall Street play into how you approach real estate investing. And so I'm hoping to just share some of the secrets that I've learned from, the people that have mentored me. The long and short of my entire business, just so you kind of have a context for it, is I have about $20 million in software, and I have about 40 people that I effectively rent out. So that's how I get things done for people, is I install technology and install people in their organization. And I typically do that for equity. I don't have anything to sell. I don't sell anything. I only do equity deals. So all of my whole business ends up in marriage, so to speak. I don't have any widget or a course or anything like that. Just to get right to the kind of the 3 secrets, I'm actually going to give you 6 secrets today, but the 3 main secrets that Wall Street knows that are typically not implemented in early stage REI businesses is the number one thing would be funds. Almost all real estate investing activities on Wall Street go through funds, and outside of Wall Street, they very rarely go through funds. And so that's what I'm going to kind of expose to you today. The second thing would be a public REIT or real estate investment trust. And that is just intrinsically connected to sort of how to get the most value. And then we'll talk a little bit about the public markets today. And then the third concept we call 1031K, sort of like a 401k, but essentially like a 1031K without any of the rules, which is really valuable. Very few people know about this. My team of lawyers kind of architected what we call a 1031 fund, which is a really popular thing right now and is helping a lot of real estate investors. 3 ideas that will kind of bolt onto that will be really powerful for you to know, which would be secondary capital, carried interest, and multiples. So if you don't understand these 6 concepts in detail, that's essentially what we're going to do over the next few minutes. I only have 8 slides total. So while this presentation is fairly visual, it's certainly not long. There's not a lot of things to digest. So the first would be, what is a fund? A fund is a 3-entity success structure. I've got it articulated pretty much in all the detail that you need to hear right here. The 3 entities are the LP, the GP, and the IM. And the LP is a limited partners. That's where the fund is. That's where the money in a fund gets deposited. The GP is the general partner, and that's where those GPs have profits via carried interest. And the IM is where the funds are controlled from. That's sort of like the nuclear cheat codes, right, where they control the capital. Now, the concept here is that you're sort of separating ownership from control, right? The founders of the fund, let's say you have an REI business and you and I are going to start a fund together. We control the IM and the GP. In other words, we put those 2 in place and we bring in investors at the top, at the LP. This structure is the #1 structure that Wall Street uses to essentially dominate where, you know, others might do really small businesses. Everything I'm going to teach you today isn't about getting into REI. It's about how to make what you do in REI much bigger and much more valuable. Because at the end of the day, here's my belief set. If you're going to do it, it's going to take a lot from you. It's going to take time away from your loved ones, your spouse, other work, play, all these other things. So you need to get the maximum amount of net worth out of your effort. And that's what a fund is all about. So implementing a fund kind of comes down to this idea. And I'm going to teach you these numbers, and I apologize because there's math, and I know everybody hates math, but generally speaking, we need to know this math. Now, here's kind of the scenario, right? On the left is a valuation of a company. Okay, it's just a fake company, so we're not going to go through this in too much detail. But the idea is that on the left, you have a valuation of a company, and on the right, you have that valuation changing or massively increasing via these little levers that we're pulling, right? So what I'm teaching you here is just the idea of, do you understand how companies are valued? And then 2, do you understand which levers you can pull in order to increase that valuation? In other words, if you're going to be in REI, why not build a business that's worth 20 or 100 or 200 times more, right? This is the thing that you need to kind of understand. And again, this is not a course. There's nothing to pay for here. There's nothing to really teach. This is just, you should understand this, right? Because if you're going to be in the game, you want to use all the secrets that are available to you. So on the left, the valuation, top line revenue is 5 million. It's just a fake number. EBITDA or net profit is 20% of the 5 million, right? Which is essentially $1 million. The value of that business is getting a 5 multiple off of EBITDA. So it's worth 5 times the total amount of net profit, which would be $1 million here. So it's a $5 million business, 5 times the $1 million EBITDA from 20% of revenue, right? That's essentially all you need to know. There's only 4 numbers that make up really a company's value. So what we're now doing is we're going to lever the 3 things that make up the full valuation, right? The revenue, the EBITDA or earnings, and the valuation multiple. For those who don't know what EBITDA is, or that's a weird number, or that's a weird phrase or acronym, it stands for earnings before interest, taxes, depreciation, and amortization. But for today's purposes, we're just thinking of it as profit, right? What's the profit in the business? So if you thought of this as like your REI business, the question is, how do we get revenue from 5 million on the left to 25 million on the right, and have this 5x gain sort of in the middle, right? The difference between 5 and 25 is 5x, right? The concept of earnings or EBITDA or profit, right? Going from 20% to 30% is a 1.5x gain, right? 20 to 30%. Now, the valuation multiple, in other words, how the business is looked at by the markets, what it would actually go for if it was being sold, right? How it's being valued by investors, people who are injecting capital. What is that vehicle you've built actually worth? This is going from 5x as an example to 15x in the right-hand example, right? Now, what's at play here? What we're doing is we're trying to essentially find ways to make, the right-hand column be true when the left-hand column's the reality, right? And here's why you should care about all of this, because simply by bumping the revenue up 5x, which is a pretty big jump, but then just a little bump on the earnings from 20 to 30%, and then this little bump on the valuation multiple, which it's kind of big and kind of little all at the same time. I'll explain why. All of that gave you a 22x. Now, if I walked into any REI business today and said, I can 22x your business within the next 12 months, most of them would think I was totally full of it, right? This guy's a liar. That's not really possible. Nobody does that. This is really easy using a fund. It's actually really easy using several tricks from Wall Street that almost no Main Street people ever use. So we're going to go through that in a little bit here, but I want you to wrap your mind around this idea, right? We had a $5 million business there on the top left, and we just added 107.5 million to the valuation and turned it into a $112 million business. Now, if that math is foreign to you, like how did he just do that? Something looks wrong here. If you go up on the left and take the $5 million business at 20% valued at 5 times, it's now 25 million on the top, right? 30% on the bottom, which is 37.5 million, and 37.5 million times 15, which is this new multiple here, is 112.5. So the math plays with your head. I've taught this thousands of times to every entrepreneur in every industry, blah, 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 right? Nobody ever fully gets it the first time around. Takes a minute to kind of look at, think through, right? What's happening here is exponential gains, because when you increase earnings, you're increasing the value of all the revenue that you just increased. And when you increase the multiple, you increase the value of the EBITDA, which was derived from the revenue. So you bump revenue, which is the thing that most entrepreneurs think about, right? More deals, more deals, more deals. I love the last presentation, perfect presentation. And it's exactly what everyone focuses on. More deals, right? How do I get more doors? Well, if we do more doors, more doors, more doors, and never think about more profit and more valuation, then what we get is just 5x, right? The top piece. We might even get to 25x on the top. But what you don't realize is that 25x times is always going to be more, right? Because the reason why we got to 22x in this math equation is because 5x times 1.5x times 3x is 22x. So said differently, we're all doing it the hard way, right? We're only focusing on doors, we're only focusing on deals, we're only focusing on revenue. When I evaluate the pie chart of entrepreneurs, how they spend their time, I never see activities that have anything to do with profits, doubling profits, or changing the valuation of the business. Now, the good news is that none of these are that difficult to implement, but they are very different than what the average playbook looks like, right? So on the right, I have a couple things here that I want to go through in each of these categories. And the context here is, if you had a fund, how would that look, right? So if I had this $5 million business on the left, but I converted it to a fund, I just took my REI business and flipped it over into a fund, which isn't complicated. Boom, all of a sudden I've got a fund. Well, what can I do with the fund? How can I hit these numbers on the screen with the fund? Well, the first thing I would mention in revenue is that you're going to be able to do more deals, right? Because you can raise more capital. The second thing is that you've got now more scalability built into the business, and you got no more seesaw because you can raise capital and deploy at will. In most syndication businesses or most REI businesses, you find a property, fund a property, then you got to go fund to find another deal, right? So you're constantly going up and down and you're in the seesaw game. With funds, they're a lot less seesaw. And so hitting more doors is usually a little bit easier. But that's not the point, right? This whole slide has nothing to do with revenue. Revenue is what everyone on this call is thinking about and what everyone on this call is doing with all of their time. Here's the magic. How do you multiply all of those revenue efforts by two other efforts that are not so manual and so difficult. One, if you had a fund, you now are the bank. So be the bank is sort of the concept that's easiest to install in your mind. It's like, how do I build a fund that I control all of the rules of how the capital is used, how it's deployed? Keep in mind, in the previous example I showed you, the previous slide, you are the GP, you are the IM, it's your fund, it's your bank, right? You're building your own little bank to fund your own deals. And you're very rarely playing by the rules of others, right? The second thing is secondary capital markets. This is one of the 6 secrets that I talked about in the previous slides, right? What is secondary capital? Secondary capital is where you might bring primary capital to a deal. Think of that as like a down payment. And Wall Street secondary capital markets will come in and finance the rest to help you do more deals. They'll finance you out of deals, right? So a really good example, and secondary capital can be used for anything, but a really easy example is if you were doing a fix and flip, right? Let's say you were doing a fix and flip and you got hard money, right? So you're paying 16% or whatever it is on hard money, and you get this property and you're rehabbing it, whatever. How long do you have to stick that hard money loan on your balance sheet, and how quick can you get out of that, right? How fast can you refi out of that deal, right? Well, there are secondary capital markets that would refi you out of the deal and free up all your capital that you put in as your down, and then you only have to maybe it only has to sit on your balance sheet for 2 days. So if you only had to sit on a deal for 2 days before refining it at a much lower rate, you would do that a lot, right? Because your initial capital frees up. So let's say you only have $2 million, but if your capital frees up quickly, it's only out for 48 hours or whatever. I mean, this is a fictitious example, right? But if it's only out for a short period of time, then it's available again. So how many deals can you do? Now we're back to increasing revenue. If secondary capital markets are constantly turning your capital and getting you into more deals, right? How bigger are the IRRs or the returns in your fund or in your real estate investing business, where instead of paying 12, 15, 16%, you're paying 6%, right? For basically the same type of deal. This is what secondary capital allows you to do, and why funds are very valuable, because secondary capital markets love funds. Why do they love funds more than your existing idea, your existing LLC? It's not audited. It's very informal. It's super easy to do. There's no barrier to entry whatsoever, right? You could call up any attorney and they would have an LLC by 2 o'clock, right? With a fund, you're sort of showing your prowess. You're showing how official and secure the investment is. And then you're also showing audited financials. All of that attracts lower priced capital and attracts Wall Street to the deal. Now, the last piece of like what is important here on increasing EBITDA is probably technology, because you can use technology to make things more efficient. You can use automation, right? So now let's get to the final section here down here with the multiple, which is it's easier to exit the business. The business is intrinsically worth more. Now, newsflash, if you had this 5x valued $5 million top line business that we see here on the left, and you turned it into a fund, it's probably already worth 15 times. The end. You don't have to do anything. So that's the sort of mysterious part about the whole thing, is like, you can just do it the hard way, and yet the easy way is actually not any harder, right? It kind of plays with your head a little bit. Like, just show that you're willing to do things more officially, more secure, right? More audited. And all of a sudden, capital's cheaper, investors are easier, right? Selling is easier, valuations are higher, and all of a sudden you have this strong buyer pool. Now, if you might be thinking, well, I'm not looking to sell my business, I promise you're looking to sell your business, because you're going to die, right? And all of us are going to sell our business one day or another. We're going to sell it to somebody else. We're going to IPO it. We're going to sell it upstream. We're going to hand it off to somebody else, or we're going to hand it to the grave, right? You are not leaving with this thing in your hands, right? So what you want to start to think about is what's the multiple or the valuation multiple? How does the market value the business that I'm creating right now in real estate? And if the answer is I just set up an LLC and I'm trying to find some properties, that's a great place to start, but that business is not very valuable, right? The multiple is not very high, right? There's 3 tricks that I think that you could implement to make a really, really, really high multiple, which I have here on the screen, a roll-up, private equity, or a public offering of some kind, a public REIT. But I feel that the easiest thing I can teach you is just to turn it into a fund. Now you can call a law firm that builds funds and pay $50,000 to $100,000 and get a very good fund that is very well managed. So it's not something that I do. I do it for free based on equity. I partner with people, but I would highly recommend that, you know, if this sounds remotely interesting to you, that you at least consider hiring a legal team to go execute on that for you, right? We have our own legal team, our own law firm. We've built our own whole system for that, right? So I'm a big fan of legal teams that know how to do this. Now, if you're wondering why Wall Street would value the business higher, why the multiple would be bigger, why can I get more value out of my business just because it's a fund? Here's kind of the insight into that if you really want to get down to the nitty-gritty, right? What is a cap rate? A cap rate is essentially how can a buyer determine a price to offer a seller, right? Well, outside of Wall Street, a decent cap rate might be 7, right? So in other words, if you had a $100 asset in this example, and someone was going to buy it at a 7 cap, they would pay $1,428 for it. But if the buyer was willing to buy it at a 3 cap, all of a sudden that $100 asset is worth $3,333, which is more than double. So the question you've got to ask yourself is, just pretend your business is the 7 cap, right? But Wall Street would buy it at a 3 cap. So Wall Street will pay more than twice, maybe 3 times what it's actually worth. But all you've got to do is really convert it to Wall Street language. You've got to set up the business so that it looks attractive to Wall Street, which is why a fund is really valuable. Now, if you're not familiar with cap rates or funds, or if some of these, you know, phrases are a little bit intimidating, just know that the basics are funds are more valuable. You should build your business based on what you think it will be worth and how to increase its value. The big triggers in real estate are funds and for sure technology, right? And you're probably going to get bigger valuations and just get a lot of leverage by utilizing secondary capital. There's a lot of secondary capital markets that will love to finance funds. So this is a big opportunity for you, right? The last thing that I would mention is inside of building a fund, there's a way to build a fund where you can 1031 all of your 1031 money into a fund. We call that a 1031 fund, or we just have this colloquial term we use, which is a 1031K. It's basically a tax loophole that allows for a 1031 exchange, but allows you to bypass the rules for like-kind exchange and allows you to 1031 that money into a higher growth vehicle, such as a fund that you could take public as a REIT. And you could also partner with other funds and take in secondary capital. So there's a way, if you've got a 1031 property, to turn it into something rather large without having to be constrained by all of those rules. And these are things that are very nuanced. They're very legal oriented. I'm not an attorney, full disclosure. This is not a legal consult, right? I'm just telling you that we build funds like this. We don't do it for service. So please don't reach out to me and say, will you build me a fund? How much does it cost? We don't have services, okay? That's just not what we do. We only do partnerships. But this concept of build a fund, use Wall Street's language, utilize the numbers to your benefit, right? And then realizing that if you want to start a fund and you have a 1031 property, you already have a fund, right? Because you can just 1031 right into this 1031K or this 1031 fund vehicle that we're talking about. And that is very, very simple to do even though it's totally a secret, right? It's 100% a Wall Street secret. And I would say that the majority of my co-presenters that I've talked to in being inside of 411 have been basically unfamiliar with the fact that there is a loophole around those like-kind exchange rules, et cetera, et cetera. And there is a way to do this inside of what we call a 1031 fund or a 1031K. So just know that that's your starting point. You know, you don't have to go and raise capital or get intimidated by talking to investors. You don't even have to build an offering. You could literally just take your property and 1031 it into a fund. We could call secondary capital to that fund, and we could literally build that thing into something much larger. So my contact info and the things you would want to connect with me on are on the screen. I intentionally kind of went through this quickly to see if we could do some Q&A, and it looks like there have been some questions that have come in perhaps. The things that would be interesting for you to email me about or ask me about, number one would be 1031 deals, 2 would be funds, and 3 would be exits. Exits of any kind, like you have a business you're trying to sell, you have a property you're trying to sell, you're trying to sell an entire, trying to get out of the industry, something like that. Any of those things are interesting. And of course, my email is there on the screen. So let's see what we have here. Let's see. So Mike, 10, 20, maybe 100. So the reason why, so let's go back a little bit in the presentation. And I want to talk to you about these numbers just a sec, right? So they will kind of blow your mind if you really think about these. So let's say you were reverse engineering, Mike, from a 100x, just like I have, described in the little teaser thing that Linda put out, right? Well, in this example, 100x is literally just 20x on the top, 5x in the middle, and 1x on the bottom, right? Because these are all exponential, so it's x times x times x, right? So in this example, it's 5x times 1.5 times 3, which is 22. 100's pretty easy if you really think about it, right? Because it might be a 10x on the top, it might be a 3x on the bottom. This is exactly how I would think about it, right? I would just think about it literally on the screen like this, of like, okay, I'm going to 20x my business in the next 12 months. Is that coming from revenue? Is it coming from earnings? Or is it coming from the multiple that the company's valued at? Or am I using the exponential effect of raising slightly all 3 examples? Very easy to do 10x. And almost just as easy to do 100 if you can wrap your mind around how to get to each of those 3 numbers. So I just reverse engineer it all out, Mike, and that's why, yeah, 10, 20, maybe 100x, maybe 500x, right? Next question, can you convert an S Corp into a fund? Absolutely. Thetis, all you do is you convey assets from an entity into another entity, right? And this isn't dissimilar to the 1031 fund, right? Where you sold an asset and conveyed it into the 1031 fund. So it really wouldn't matter where your asset was, because you're not trying to convert the S Corp into this 3 entity structure that we call a fund, right? You're going to take the assets out of the S Corp and move them to this structure here, right? So not difficult to do. Considering, an LLC as an S Corp is a fill in the blank, right? In terms of them just holding assets. So you would have your, legal team, or I would have my legal team draft up an asset purchase agreement or an asset conveyance agreement that simply conveys the asset from the S Corp into this structure that you see here on the screen. So very, very simple. let's see, gas stations sold for 3.5, 1030 fund, one fund, I need an attorney. Absolutely. Easy to do, right? Sold for 3.5, easily convertible into the fund structure. Now you've got the right vehicle. It's Wall Street compliant, if you will, right? And now you can truly scale and start to think about all of these numbers, right? How do you turn your initial 3.5 as your first door, for lack of a better word, and then leverage, leverage, leverage. So yeah, 3.5 million, Mike. Exactly. So if you start with $3.5 million in cash, you now can go to the secondary capital markets and get more capital based on that conveyance, right? So we can all of a sudden get the 3.5 to make 10 or 12, or we could take your 3.5 and get a credit line for another 3.5, right? Now we've got 7, right? And by the way, Mike, in your example here, you don't have to go buy more gas stations. You can buy different things, right? This is not a like-kind exchange scenario. As soon as you 1031 the money into this structure that I'm speaking about, the 1031 rules are solved. You don't have to go buy 5 more gas stations. You could literally do whatever you want. So let's kind of turn it off from there. That's pretty much what I have. How many days do you have, Mike? It's probably best to talk to the attorney, right? Because I don't know what situation you're in. The day limit would probably still apply, but getting that papered up over into the new structure is not nearly as hard as finding a new property, right? That's where we all struggle with our 1031s, isn't it, guys? Where we have something, but we don't have anything to put it into if we sold it today, right? In this example, you don't have to worry about what you're putting it into next. What you're putting it into is this new bucket, right? The new fund bucket. So at full disclosure, Mike, you can build a fund with any sort of fund attorney. So you could literally jump online and like Google fund attorneys in Dallas or whatever. Like what we do is we have our own law firm internally that builds all these types of things. So, you know, we just do it internally. There's no fees. And the 1031 fund is not something that I would say many people know about. So I couldn't even vouch whether an attorney would even know about that. That's very much a Wall Street secret and a tax loophole that my team kind of pioneered the instrumentality of that in some ways. Now there is knowledge out there about it. I'm not saying we're the only people in the world that know it, but it's definitely not a common thing. So appreciate the comments, guys. Let's see. Cost of doing it. It's a great question, guys. Like, because I don't do anything cost-wise, right? I don't want to speak necessarily to what costs are. My experience is that if you don't pay at least $35,000 for fund documents, you're probably not getting anyone who knows what they're doing. And that's what typically keeps people away from building funds is they're like, oh, well, that's a lot more expensive than just getting started and paying $100 for this LLC. But as you can see, you don't pay for it now, but you pay for that decision so much later in the value of the company, right? Whether you're going to sell it or raise capital into it or attract primary or secondary capital or attract more investors, whatever, you pay for it so much. We usually put about $100,000 worth of legal work into our funds in the first year, just on behalf of our partner. So like if someone on this call was like, oh my gosh, I have a 1031, I want to build a 1031 fund, we'll put about 100,000 on our end in terms of legal services into it. That's just our cost. We don't pass it on or anything. But I'm sure that if you find the right attorney, you're going to range probably somewhere between $35,000 and $100,000 to build a fund. But again, I can't speak to the 1031 stuff because my guess is that the person you call will Oh, thanks, Jason. Appreciate that. Yeah, guys, so my info's on the screen. If I can help, you can just email questions to the email address you guys see down there, g@toolboxos. But yeah, before I go, just wanted to try and inspire you a little bit to just, go after this. There are really good opportunities in real estate. I believe that they're not necessarily in the places that we typically have looked in the past. I'm seeing amazing deals in, mobile homes, RVs, a whole bunch of different things. I love the last presentation because I would have never thought of Oklahoma City, right? Or whatever it is. So there's always places to make money. It's just if you're going to put your time and effort into that, you want to get the most out of it, right? And the things in this presentation are just designed to help you do that. And so I'm appreciative of the opportunity, Linda, and we'll hand it back to you.
Wonderful. Well, thank you again, G, for joining us today. It was a pleasure to reconnect. And I want to thank you for sharing your insight and giving some tips to our viewers. We really appreciate that very much. Now, is there anything that investors can do to get to that next level? Any last minute tips that they can implement this coming week?
I think the only thing that's implementable that fast is kind of what Mike was talking about in the chat regarding, a 1031, right? Because, you can set up a structure to convey that into, even if you're at the last minute, where you don't have to go find another gas station, right? And that's like a perfect example of why a 1031 fund might be super valuable, is that like you just really can't find the right property to 1031 into. So I think the 1031 scenario is the one that leverages everything the most and you can actually get done quickly. Setting up a fund top to bottom takes about 9 weeks usually. It can take longer, especially if you take a while to get decisions made or things like that. We can get them done even quicker than 9 weeks, but that's kind of gives you an idea of how long it would typically take. If you're under the gun on a 1031, then obviously we can 1031 it quicker and then worry about all the fun details later, right? So we could set up that actual conveyance into the new structure and then sort of backfill the 9-week process to build all the fun documents and details around it. But I mean, that's the only thing that you can really do in short order, right? And for lack of a better word, I'm not a deal strategist, right? So I don't know how to help you find the next deal. I think that's what the last presentation did very well. My presentation is more like, hey, regardless, whatever deals you're doing, how do you get the most out of that, right? Assuming you know how to do deals. So the only thing that's really easy or quick is probably a 1031. A fund set up from scratch, is going to be at least a 9-week process. And like I said before, is going to cost you up to 100 grand. If you end up doing a partnership, like partnering with us or somebody like us that does what we do, then, you don't have any cash out of pocket, but you still have that time to set it up and make all those decisions.
Wonderful. Well, thank you once again, G. Now, is your information on the chat? Would you like to share any contact information with our viewers? Or do you have the social media perhaps that you would like to? Oh, there we go.
Yeah, it was on my last slide, but I just dropped it in the chat so everyone can see it there.
Okay.
I don't prefer social media personally. Okay. It's I'm in the equity world, so I don't really want anyone to talk to me. I want to talk to who I want to talk to. So it's kind of one of those scenarios where if you've got a deal, if you've got something, if I can help, you can email me directly. And I do have an assistant that manages my email. So we're fairly on top of that now. And I think you know what I'm talking about because you email me all the time, Linda.
Yes,
so.
Yes. G, again, pleasure to reconnect with you. I would encourage everyone to see G speak in person when you can. When we return back to Florida, we'll definitely contact your assistant, G, so you can join us once again for our next in-person event in Florida, if
That
you're
would be
available.
great. That would be great. Thank you.
Thank you. Wonderful, folks. Well, it's a pleasure to have you with us today, everyone. And we're going to keep the ball rolling and learning from great speakers and educators. And next, we're going to learn from Daniel Volumino, who's a diversified revenue expert. And he's going to be teaching us how to turn liabilities into assets. As landlords and real estate investors, this is valuable information on how you can improve your bottom line very easily. So we're going to learn all about it. Daniel, welcome.
Well, thank you, Linda. How are you doing?
Oh, doing great. Thank you.
Fantastic, fantastic. And thank you for allowing us to speak today. And to all of the colleagues that are on the line today, I know you've had 6 hours of incredible information and our heads are swimming and such great, great info. So I'm going to keep this short and sweet. I know it's a Saturday and people have things to do. Just need about 10 minutes. And I want to kind of dovetail into a lot of the things that you've already saw today within the real estate marketplace. And we're basically going to talk about several verticals. And what I'm specifically involved with, I've been involved for 27 and a half years, is the multi-trillion-dollar industries of telecom, energy, merchant services, identity theft protection, and health sharing. And over the last few years, our business model has morphed where there's some extreme potential for, there's niche revenue potential for real estate, realtors, commercial, residential, and especially multi-unit business owners. And today's not meant to be a huge 40, 45-minute detailed concept. I'm just going to give you a 10-minute flyby and then invite you that if you have an interest or, you know, this fits your profile, to connect with us at a separate date. I promise, Linda, I'll keep this to 10 minutes. So let me pull up the slides here quick and we'll kind of just fly through this. Okay, so basically, what we're involved with is cellular, gas and electric, internet, home phone, home security, television, credit card usage, identity theft protection, and health sharing, both at the commercial and residential level. And we either own or represent providers in all of these industries. So to be specific, ID seal identity theft protection, Flash 5G wireless, Vivint smart automation, Zoom gas and electricity, Sphere merchant services, Dish Network and DirecTV television, AT&T wireless, AT&T Spectrum Frontier, TV phone or internet, and Impact Health sharing. So we either own these companies or represent these companies, both residentially and commercially. So I want to keep the last 7-8 minutes here specific to the real estate marketplace. So basically, our business model is an online storefront business model where businesses and individuals can go to an online storefront, look at what these providers offer at their addresses, and get better deals through this online storefront model. Now, for each of you on the line, you have the ability to earn upfront bonuses for acquiring services. And the biggest key is the backside residual income, where you can actually earn up to 20% of the commissionable revenue of these folks and these companies' bills every month that they pay them. And because our energy residuals are lifetime of the customer payouts, for those that are multi-unit owners, this becomes a hard asset of the building, affecting the NOI and the cap, and actually creating an increase in the value of the building as all of this residual income is sellable and willable along with the building. So that's just kind of a taste. I want to be now specific to the real estate industry. So because we have different folks on the line today that are coming from all different parts of the real estate paradigm, let me talk about 3 of our real estate verticals. We have a residential realtor vertical. Let me explain this. We know people, some are part-time, some are full-time in the residential real estate market. So as realtors, make a sale to their client, most of the time, they're going to hand them a sheet of paper at the closing that's going to give them all of the names and phone numbers of the essential providers for these types of services at that zip code, at that address. And they kind of do it as a courtesy. So the idea is to, just a courtesy, give this information to your client. Well, our model allows it to be more fruitful for both parties. First of all, instead of handing them a sheet of paper, you can direct them to your online storefront. Now, what's in it for them, the client, is because of our volume of what we do for these companies, they're going to be put in a better position to get their services through your storefront than going to these companies directly. So that's what's in it for them. Now, what's in it for you, besides just feeling good about the courtesy, you actually paid upfront weekly bonuses and a backside residual income every month that client pays their bill. So from a residential standpoint, I guess a term we could call it be like becoming a kind of a real estate concierge service, except they're getting a better deal and you're getting paid instead of just the handshake and the feel good. Now, on the commercial piece, we do B2B. So if you're doing commercial real estate, the folks you're selling to have commercial gas and electric bills, some very significant. Some of them accept credit cards at their place of business. If it's a smaller deal like a strip mall or something, they're going to have, some sort of security on their business. Well, as you sell B2B, your commercial property, you can also send those commercial clients to your online storefront because there's a commercial section of your storefront where we market those things. Again, putting them in a better position to pay less on those bills, and you're getting the upfront bonuses and the backside residual. And the backside residual of some of these commercial accounts can be positively staggering. Now, the third piece is multi-unit building owners, this vertical. And I'm going to focus on the gas and electric piece here because that is the most fruitful and the easiest turnkey to generate revenue in the gas and electric markets. Now, as we know, only 19 of the 50 states are deregulated with gas and electricity. So I want to give you a map of the 19. I'll get out of the way. So if you own any multi-unit properties or know people in those states, those areas, California, Connecticut, Delaware, Washington, D.C., Georgia, Illinois, Indiana, Kentucky, Maine, Maryland, Massachusetts, Michigan, New Hampshire, New Jersey, New York, Ohio, Pennsylvania, Rhode Island, Texas, or Virginia. If you own properties or know people own properties in those states, we are marketing Zoom Energy in that marketplace. And in that marketplace, we are very, very aggressive in our marketing and our strategies and our pricing, and just an incredible way to drive a revenue stream for the multi-unit building owners. And there's three scenarios that I want to just glaze over, share with you before we wrap up. If you look at multi-unit buildings, the older buildings, and even some of the new ones, most of the older ones have master meters or master boiler or large boilers in their basements. If the buildings have master meters or boilers, we do offer large commercial account pricing. So with the master meter and boilers, basically what's in it for the building owner is to potentially pay less than more on your therms and kilowatts, and then getting a residual on the backside of all of the usage that you're using in the building. The second piece is where there's individual meters in each unit that's paid by the tenant. Now, this is a little more fickle because it's the tenant's decision who they use, the bill's in their name. We have to engage the property manager to encourage the tenants to use Zoom Energy. Now, in this instance, there is upfront bonuses that are paid. Basically, it's $200 for every 3 gas electric meters to get flipped, plus an 8% net residual. So in this example, every 3 tenants that choose Zoom Energy in that building, the owner would get a $200 bonus. The tenants would get the savings on the therms and kilowatts, And then the building owner would pick up the 8% residual of the bills. But because those tenants can pick and choose who their provider is, this isn't necessarily a hard asset. So the third example is the best of all worlds. That's where the units are individually metered and they're paid by the building owner, where the building owner is autocratic on who they use for the energy. So in this piece, let's say they have a 200 unit building and they flip the whole building over to Zoom and it's individual metered, paid by the building. The building's going to get the $200 for every 3 gas-centric services moved over up front, which could be thousands, tens of thousands. And some of the companies we've dealt with that have 1,000 and 2,000 plus unit buildings, they've earned hundreds of thousands of dollars up front. The savings, because the bills are paid by the building, go directly to the building owners on the therms and the kilowatts. And here's the biggest key. The backside 8% net residual of all those therms and kilowatts bills go to the building owner. And we put the building in as the entity here. And that becomes a hard asset because it's not up to the tenant on who they use. The building decides. And because the building decides on the provider, and it's a lifetime residual, that becomes a hard asset of the building. And that hard asset, I'm not going to go through the math of the NOI and the cap, but here's what I can tell you. We've had people's building values jump by anywhere from $500,000 to literally millions and millions and millions of dollars because of the NOI equation being affected by this being a hard asset. And you look at the full year of residual income that's paid back to that building, and that's a hard asset that goes right into the calculation of the NOI and the value of the building. So it's just incredible. Super exciting for that third example. Now, I'm not going to go any further into these examples this evening. Linda, if you could do me a favor, could we make Ines if whoever's running this can make Ines a panelist, that'd be great. She's on as Ines Volanino. Is that possible?
Of course, we'll do that
Thank you
right
so
now,
much.
Daniel.
All right, thank you so much. And folks, with that being said, my wonderful wife is a global expansion leader with our company. She speaks 4 languages, English, French, Arabic, and French. She has a global business. She's one of the top performers in her entire industry. And she's been working over the last couple of years hand in hand with residential realtors, commercial realtors, multi-unit owners. Her expertise is with multi-unit owners. She's helped them within the Arabic community. She's helped them within the Hispanic community. There are many people, both from Canada and Europe, that speak French that she's worked with. And of course, she's fluent in English. And so she's going to kind of take over for the last 3-4 minutes here to kind of give you an idea of the scope of the industry and what the next step would be to potentially either A, look at this from the residential real estate concierge concept, B, the B2B commercial real estate marketplace, or 3, this multi-unit building paradigm, which is broken into those 3 scenarios I shared with you. And we'll get much more detailed on this with our subsequent webinars that she's going to talk about. So Ines, I'll turn it over to you. It's all yours, man.
Well, thank you so much for this kind introduction, Mr. Volonino. Hello, everyone. Good afternoon. My name is Ines Volonino. I'm from Paris. I live in Florida, and I'm excited to be on that webinar today. What a great day so far, all those training and all those interesting things that we learned so much today. And I'm super excited to be here again with you. So just to end our training, our part here, I just want to remind you, just one quote from one of the most phenomenal gentlemen when it comes to business. And Warren Buffett is the one who mentioned that deregulation is the largest transfer of wealth in history. So it's not about what we say to you. Ines or Danny say to you, but it's as well all those big people who have a big wealth, who knew how to capitalize from different industries, mentioning that energy is one of the biggest and the largest transfer of wealth in history. So absolutely, you want to take advantage of that opportunity that just Mr. Volumino just shared with you. And as well, we want to talk further in detail about that opportunity, this concept that we are involved with and helping so many people, so many realtors, investors, and as well multi-unit owners capitalize and profit on those bills that we have to pay anyway. And just by putting people in a better position, what a blessing is that opportunity. So we want to share more detail with all of you during those two sessions. So you can pick up, you can choose one of those two. So we have two 25-minute live webinars scheduled for Monday, 26th, September 26th at 7 p.m. Eastern time, so 4 p.m. Pacific time, or Tuesday, the day after, 27th, at noon Eastern time or 9 a.m. Pacific time. So you can just use the chat and just type in one or two. We will make sure that we will get all the information needed to be able to join those webinars, to learn more about what we do, how we do it, how much we are talking about, super important questions. I know that it's really great and you get the idea of what we just shared with you, but still, I'm sure you do have questions and you want to learn more about it. So grab, a screenshot of that and send us, use the chat. And as well, you can contact Linda directly just to find out, to receive those information, whether you want to attend the 25-minute live webinar on Monday or Tuesday, according your preference, according your convenience. But as well, if you want to send us a text or contact us directly by email or just a text with or using, a phone call, using those phone numbers. So you have the personal information for Danny and I on the screen. So just grab a screenshot. You can email us. I received a lot of emails from yesterday. A lot of people want to learn more about it. So they kind of, send me an email with the time that they chose. No problem. Just you can do the same thing, whether you use the chat or you want to text us directly or call us or send us an email. We will be more than happy to share that information with you so we can talk about strategy and how we do that business, how we get paid on tenants' bills, how we get paid on all those essential services, mainly on the energy industry. So thank you so much for your attention. Thank you, Linda, for inviting us on that webinar today. Thank you all, and God bless you. I turn it back to you, Linda. Thank you.
Thank you again, Inez and Daniel. Such a pleasure to have you with us. And it was wonderful to meet Inez and Daniel in person at our Florida event. Yes, I met them at our Florida event in Fort Lauderdale, and I was able to learn more about this and also sign up. So I did already sign up as a customer, and I'm excited about the future with this. So I want to thank everyone for being, on this webinar with us. And we shared 2 days of fantastic information, knowledge, and hopefully we motivated many of you to take action and to either start your real estate portfolio or expand your real estate portfolio. And that's what it's all about. We want to help you. We want to make sure that you're connected with the right people that can take your REI business to the next level. And with this in mind, I will go ahead and put in the chat the website. Hold on one moment. Let me put a link in the chat where you can join our VIP member group. If you do that, you'll be able to get our next issue, our next magazine mailed to you directly. Now, it does cost $27 a month, but you get a lot of benefits. You do receive a magazine every couple of months in the mail, as well as great VIP merchant discounts with top name retailers across the country. And if you'd like to visit theme parks, you also get discounts through our VIP member site to Disneyland, Disney World, as well as Universal Studios Hollywood. So we have a lot of perks that you can receive if you're a VIP member, and I hope you take advantage of that. So I went ahead and posted that in the chat. And I want to thank Jason Burke for joining me and helping me with the technical aspect of this event. Jason, you want to come on and say goodbye to everyone?
Yeah, you're welcome, Linda. It's a pleasure always helping you and adding value here in Realty411, the platform you created. And yeah, thank you everyone for attending today's day 2 of the Realty411 virtual event. I covered you 10 upcoming future Realty411 virtual and live events. And thank you again, Linda.
It's always a pleasure to connect. Let me see if I can go ahead and put our next issue on the screen. I will try and do that so you can see what the next issue is going to look like. And in the meantime, I would also encourage you to please drop Ines or Daniel an email. Their information is also on the chat. That way you can go ahead and receive information about their next webinar to utilize this concept in your multifamily properties. So here is our next issue, folks. I hope that you can become a VIP member so that you can get our next print issue. Inez, Daniel, is there anything else you'd like to add before we say goodbye?
No, I think we're good to go. Look, just forward to seeing everyone on Monday or Tuesday.
Okay, wonderful. Well, folks, go ahead and connect with Daniel, with Inez. Be sure to join their webinars. I want to thank everyone who was a part of our group for the past 2 days. We learned so much. I hope it was a benefit to everyone. With that in mind, we're going to go ahead and close this session. Thank you again for being a part of it, and have a wonderful weekend. You're welcome, RJ. RJ said, thank you, Linda. I have learned so much this weekend. All the speakers were great and shared so much of their knowledge. RJ, it was a pleasure. I'm so excited you had a chance to watch Joseph from Lending One and to reconnect with him virtually. Jay Miller, thank you so much for saying thanks. We appreciate your feedback, and it's always a pleasure. Mike Chander, I'll see you in our next event live in person in Los Angeles, October 22nd. I know that you attend our in-person events, and I hope to see you at our next one, which is the LA Grand Expo, October 22nd in beautiful Los Angeles, California, the city of angels. Thank you again, everyone, and have a blessed weekend. Bye-bye.